Wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Hey guys.
What's up, everybody? Good morning. Happy Wednesday. Just had a profit tag there on SPX. Very nice. So closing out with a couple of nice winners this morning. 218 closed out for $1.70. Okay, so quick update. 2 for 2 on the day. Good. All right. So seeing some green in the portfolio. Yesterday I was not a happy trader yesterday. A little miffed at just how ridiculous this sell-off was. I had a conversation with my live session this morning about, look, I keep going back to, I know it doesn't seem like anything good is happening right now, but I truly believe that there will be some bullish opportunities in this near term. I think this market is likely, and I said this from as soon as we started to see this kind of systemic drop and we bottomed out around 4,800, that was the technical levels coming together within 3 days. You know, I mean, when we hit the highs of the year, dropping to that 200 moving average around, it was about an 8 to 10% correction. We hit that, and then having a little pause for 2 weeks and another drop. That flush was awful, right? We still have escalated tensions between U.S. and China. I actually was giving some golf lessons last night, and I saw the whatever dinner Trump was at, and there's like a 6-hour countdown. I'm like, great. Midnight, everything goes into effect. I'm like, is this market going to do something stupid overnight? And so I stayed up pretty late watching the futures market just in case. Nothing really happened. So long story short is this. I think that this market is capable of sniffing out these lows. Sentiment is trash. Okay, S&P 500, you've got only about 5% of stocks above the 200 moving or the 50-day moving average. You have like 4 to 5% of Nasdaq stocks above the 50-day moving average. The market is like beat up. The market breadth is garbage. Okay, I do think that is a short-term buying opportunity, and all the market is needing is some literal positive sliver. Like one glimmer of hope, and this market's like it can rally. Now, the rally I don't think is going to be sustainable. I think the rally is going to be a short covering. I think this is going to be the type of move that runs back into, obvious levels of resistance, but it's enough to help traders de-risk. It's enough to see some green. I am trying to look to be somewhat aggressive in that environment and not do anything silly, but I'm certainly not trying to pick the bottoms without defined risk. I was tempted. I was actually looking at, I put a trade on last night. I actually deleted it from the Pulver alerts because I'm like, this is just a stupid, risky trade. So I didn't. It would have been, right now, had I taken the trade, it would have been up around $150 per contract. But I'm like, just in case, if we were down to the lows, it would be, probably down $500. So it's just not worth it. So I just got rid of the trade. I dumped it for about a $200 loss yesterday. Anyway, it is what it is. But my point is, we're still kind of feeling out these lows, right? I think if you're looking at levels, it's pretty obvious if the market is going to find bottoms to rip from. Pulling back and filling this gap is a large area for the bulls to go after, and finding these lows is a large area as well. So we've got kind of area 1, area 2 to de-risk. If we come back into this 200 moving average, that would be area 3. I'm not getting super excited, but I would say that I wouldn't be surprised if we truly have a bull rally in a bear market, that this pulls back towards the 200 moving average, maybe gives traders a bit of hope, and then crushes all their dreams all over again by getting above the 200 moving average and then failing, right? So if we do this, for example, and price action comes above above the 200-day and then back below it, I would resume hedging. I would resume possibly taking some short action, like bear put spreads or something along those lines, and looking to see if we get back down to these lows. Okay, so just a couple things to watch for in the bigger picture. You're seeing some green across the board today. That's fine. This is the chart that I kept referring to. This has been an ongoing conversation now for about a month. Where is my, those are all currencies. I'm looking for that funny little S5. I just need to memorize this S5FI. This guy. So 5% of S&P stocks above their 50-day. Again, one of my favorite indicators for when the market is so bad, nobody wants to buy anything, and that tends to be some of the best market timing. Truly some of the best market timing. So that's why I like it. And I know that I can't necessarily pick the bottom, but I think that a trade or a defined risk trade that is at least sensing some lows could be very, very useful. So, I mean, realistically, it's like at these levels, I mean, here's one way to do it. Honestly, if I do this right here, let me just check this out. If I go SPY and I do bull call spread, I'll go SPY bull call spread from these lows. Let me see what this is going to cost me. I mean, volatility is still very high. Premiums are still very high. Being long anything as far as option trades, it is pretty pricey. So I would want to put a spread on, or else you're just going to get your butt kicked. The other trades I like to do are synthetic trades, which would be I buy a call, sell a call at the same strike. That's like owning the shares for nothing. Like I own the shares without tying up any buying power, um, or expecting to cover my premium. So, but to do that, if I went out now, it's like I think if we survive this like April 17 expiration, which is next Friday, and we get through that from April 17 to May 16, that next cycle, seasonality wise, and how bad things are with sentiment and the 50-day moving average and market breadth, I think that 30 to 60-day window is pretty encouraging for something bullish to happen. I really do. Earnings that are happening right now are, I don't know if they're necessarily going to reflect all the chaos that's going on here, but the transcripts will, right? I mean, the calls, the transcripts, but earnings themselves, like the EPS and revenue, may not be reflected in anything we're seeing right now. That'll be next quarter. So anyway, if I looked at SPY or RSP for that matter, but I do think that Mag 7's been beat up so badly that could also be a swift recovery. So I would want to trade the SPY if we're going to have like a broader market move. It would be, to me, it's fairly short term. So if I went out to, end of May is 51 days, June to June, this is the June 20th, June 30th, that would be like the end of the quarter. I don't mind saying like, look, by the end of the quarter, I think the market's going to be higher. So if I put a spread on, it doesn't really pay me my max profit until towards the end of that expiration. So this is the tough part, is like, I want to be bullish. I don't want to pay a ton for that premium. I want good asymmetry if I can get it, but there's just no like great way to do it. Because the shorter term I go, the less confident I am. Right? If I was like, well, I'm gonna be bullish for 30 days. Well, if we chop around here for 3 weeks, there's no direction. A long option is going to get chewed up by time decay. So a spread is helpful. I guess I could do something like really simple and just say, well, I think we're going to go higher. So if I were to, buy a 500 and sell a 505, it only costs me $3 to make $2. Like, that's not awful. I could probably put in some type of asymmetry here where I don't really want to spend more than maybe $500. So this is about a $580 risk to make $400, but I don't make $400 until closer to expiration. Although I think we could be well above 510 by expiration on this trade, So maybe the better trade, in all honesty, I'm going to do this instead. I got a plan. All right, I'm going to do a fancy little strategy called the Zebra, and I'm going to buy 2 contracts at 465. I'm going to see what it costs me first. 2 contracts at a 70 delta, and then sell an at the money call. Okay, so for $2,300, I'm essentially synthetically long the S&P. Should be there. Oh, fudge. That's way more expensive than I thought. Really? Well, I don't like that trade at all. Let me try something else. Let me go XSP for the mini index. If I go out to, let's go out to June, and let me take a look at these instead. So I'm trying to buy an in-the-money call and sell an at-the-money, create a synthetic trade where it looks like I'm long, but I can protect the downside with the defined risk. So let me see what this looks like here. Come on, options. So I had all right, just letting that line up. So here's my 70 delta, and here's my at the money. So if I sell this and then add a contract there, son of a biscuit, man, that's a little bit pricier than I want it to be. Now the risk would be, so I'm long the 465. I've got to pay $85 for that. Yuck. That still makes the break even. Yeah, it's just not great. So the positives are this: unlimited profit potential because I'd be long the asset, but that is a much larger loss than I'm comfortable with. In case I'm wrong, and that's obviously a trade that's only going out to June. So if I'm wrong on that, I'm wrong. There is a slightly different way to approach this. Would be I buy a call and sell a put, and I do that for $4, and now I have unlimited profit potential. But I'm on the hook for essentially every 10 points of movement is $1,000 in risk. So that's not that great either. I'd have to be really confident I can call the bottom there. So anyway, I just think the way to do it is just taking some bites. Broadly speaking, I wouldn't mind just getting bullish on something. This isn't a bad play. If I go XSP is a little bit less liquid, so I kind of want to go SPY. And June's not awful. One way to kind of benefit from this is we're trading around 500 right now. If I did like a 495 and sell the 505, see if I can maybe decrease some of the extrinsic value here. So this one's not terrible. It's making me pay about $6. Gosh, man. So $6 to make $4, 7 to make 5. $8 to make 5. I guess it's better off if I just did like a 500. Let me see where the asymmetry lies here. So if I buy a 500, sell a 505, cost me $3 to make 2. See where I can get this kind of match up for like a 1-to-1. It may not be there. Like the premiums are a little bit pricier, and I'm going to have to spend 6 to make 4. Like that one's okay, but again, I'm not going to achieve that full $410 per contract until closer to expiration. So anyway, I'm just going to hold off. I think I just need to freaking be patient. That's the hardest part right now. It's like I'm seeing all these signs of why I'd like to be bullish, but I'm seeing little to no price action to support that evidence. So, and honestly, we've seen such big swings here the last, couple of days in trading that it has certainly not been easy. I mean, we have had intraday moves as high as I can remember since since COVID, or I would say since 2022 maybe, but we didn't have moves like this in 2022. We didn't have an 8% day, right? Intraday 8%. Intraday yesterday was a high to low 6.7%. Those are monster swings in the market. All right. Okay. So let's take a look top down. Prices so far pretty calm. We got FOMC minutes this afternoon. I think the team is going to be streaming until then. We're kind of doing a marathon today, is from the sounds of it. Okay. All right. Give me 1 second, everybody. Okay. So we're seeing some green today. That's good. Futures market, nothing too exciting. Just expect some volatility, expect some noise. I'll just throw a couple things out there. Look, I like where we're at market breadth wise. This is the kind of the official pain. After today, we should get a reading on AAII sentiment. It wouldn't be surprising if we're continuing to see just horrible sentiment, maybe even to extremes. This was last week's print. We're gonna have another one today. This would be four to 5 weeks in a row with like a monster differential between bears and bulls. Um, I know that sentiment's not a signal, but it still is showing like how fearful things are. The odd stuff happening right now is the bond market. That is the one thing I'm really wondering, like, what is breaking. Here is the 10-year yield that is up a lot. So I mean, it could be just a quick like one-off move, but the last 3 days this has ripped higher, right? I mean, we've seen if you saw this during Liberation Day, it's like the 10 years below the four handle, and the administration was celebrating. It's like, you idiots, it's not going to stay there. And sure enough, what did the market do? Rips up 62 basis points. It is actually higher than what it was during Liberation Day. So not working, this whole idea of US China having to do something together. I mean, I'm reading both sides of it. It's really interesting how, I think there's on one side, you've got China with absolute power that doesn't care how bad this gets. Um, but if we tariff everything on China goods and we stop buying China goods, is that a slow bleed for China? Maybe. Do other countries align with them? Maybe. Um, I don't know. Like, I don't know who is strategically better. I know the U.S. has all the leverage, or had all the leverage. I think that leverage is dissipating very quickly. Um, I just I don't know, and I don't think they can. I don't think they can go unstoppable force, immovable object, and collide in this game of chicken that somebody's going to flinch. I don't know who. I would imagine that our ties to the financial markets are way more important than China's, because right now domestically, nobody in China is buying stocks. Everything in China is real estate. All right. And real estate has been in the shitter for years. And it's essentially being propped up and ventilated, but they want to decrease the percentage of investments in real estate. And I think there's a backstop, but they're no different. I mean, look at we can go HSI for the Hang Seng. Let's go just the index here. I mean, Hang Seng has given back a lot of its gains, but it's not back to where it was just a year ago. Does it get down to where it was a year ago? Do I think they care? I don't think they care. If this market just resets and we're like, well, we're on the brink of a global catastrophe and China's right back where they started for the last couple of years before they came out of COVID, I think they're way more resilient in their markets than we are. Um, yeah, everyone's talking now like the Fed's going to start chirping in. The Fed's going to start doing something. As the Fed changed its stance, or the market's changing the stance on where the Fed's going to cut rates in May. I don't know. Everyone was pricing in a pause, but now you can see that it's about 50-40, right? Pause is still a higher percentage, but not by much. This has been, inching up here the last couple of weeks, especially. So we still are looking for a pause in May. Maybe there's some insight with that FOMC today. So FOMC minutes may be showing something, but cut is likely coming in June and July and September. and October. So that would be 4 cuts through this year. That's what's being telegraphed right now. The Fed has been like eerily transparent, where when they put this out there, this is about what it ends up being. Obviously, we were surprised last year with that like 50 basis points cut, and the market didn't like it. The bond yields did the exact opposite than what the Fed's done in 40 years. So all sorts of like bass-backward things were happening. Now it's four cuts. It started out as 2, then it went to 1, then it went to 0. Now it's 4. It's all going to change. But I still don't think that the put is in for the Fed to protect the bottom here at 4,800. The scary part is if we don't bottom in here, I get it, we could be noisy, but if we don't bottom in here, then there's open space that scares the crap out of me. Like, this is why I have hedges that pay like 1,000 to 2,000%, because if that's what I need, that's what I need. But if I don't, then this is what I'm saying. Like, the market can have a high, low, lower high, lower low, lower high, maybe lower low. And if we're lucky, if that's a 5-wave move, if we're lucky, then the market bottoms and starts its way back up, right? But what I don't agree with is current U.S. government saying the market's going to boom, right? Navarro saying the market's going to boom. Trump saying the market's going to boom. I don't buy that for a second. I think there are bigger things at play here when the bond market is doing really uncorrelated things. The dollar's doing uncorrelated things. Gold's doing uncorrelated things. The markets are dropping to extremes we haven't seen in since crisis times, and that's where I'm saying it's just not worth taking the unnecessary risk right now. I want to be greedy, I really do, because this offers up really good opportunity. But unless the Fed is going to step in and do something like add resiliency to this market, add liquidity to this market, that's my biggest concern. Is like every real backstop we've had has been the Fed's right there. The Fed's right there. If they're not doing anything to, like cutting 25 basis points should not reassure this market. If we're cutting rates in the wake of a like doom and gloom recession, that's not good. It's like the Fed can cut to 0. It doesn't freaking matter. The market's going to drop. So anyway, it's just a time to pay attention, be cautious, whatever. Okay. Let's keep going top down here. Let me get some comments. Um, let's see. Good level of bear to defend. Yeah. Well, the reality is this. I talked about this yesterday in my YouTube session at the final hour. These hedges that I have on right now. So I'm sitting up around about 66 grand in hedges right now, between ES and MES. I've got some hedges in the S&P as well. So SPY hedges are showing, like, hedge right here is up about $1,000. Hedge right here is up about $1,000. So I've got another probably $8,000 or $9,000 in hedges on the SPY. But those are all out to August and December, and I'm going to let those run, because I think if the event happens where I need them, that's it. I need them, And I did the math on this one. This hedge alone. Oops, use different color here. This hedge alone has the potential to pay over 500K for all my accounts. Well, I'm down 200 grand with open P&L, with something that I truly believe this. We survive April 17 without too much damage. I think April 17 into probably June, the market is looking for any reason to rally, and it could be near term, it could be a short term. If you want to know like the periods of like what a bull rally is in a bear market, it usually gives you about a 2 to 3 week window. So if we start to rally, don't expect much out of that for maybe more than like 2 to 3 weeks. If it's aggressive, 2 to 3 weeks, I would be peeling off profits. I'd be deleveraging, de-risking, taking profits where I can, and getting back to neutral, building up cash again. I want to build my cash position back up. Okay. I want to build this back up to like 1.4 million, 1.5 million. I want to be more in cash, ready for another event. Okay. So I'm hoping that, if we pull back to, let's go SPY, 530, 540, XSP 530, 540, SPX would be somewhere between like the 53 to 5500 window. That's my de-risking window. And I'll get ready for something else. But if we do start to go up, I'm thinking it's short-lived. I would say at best, 2 weeks. Well, at best maybe 4 weeks, but I would say on average you're getting about a 2-week rally in a bear market. That's what this was. This is a 2-week rally, and that's going back like every bull rally in a bear market has averaged about a 2-week cycle. So anyway, that's that. Why April 17th? It's a big monthly expiration. It's the same reason that COVID lasted from February 20th to March 20th. That OPEX cycle, that one month cycle, it's like the options market, the futures market prices in all these terrible things, and all the flows are kind of dictated towards like the bearish side. And then once those are done and those options are expiring, then it's starting to give the whole world a chance to reposition. So if we can survive April 17, meaning like next Friday, without doing too much more damage to the downside, I think it gives the market time to kind of ventilate, maybe have a little risk on for a few weeks to let some of this pain out of the system, right? And plus it gives the VIX a chance to cool the f down. Like this has been the one thing that's been nuts about this little rally in fear is that the VIX has been persistent every single day. Okay. So, I mean, this has been one of the more like charged VIXs that I've ever seen. Usually we see like this, where it's just a crazy, stupid outlier event. Nope. This has been like steady, 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 steady. So we had a bit of a peak here, but we're still very elevated. And until we start to see more signs of this going down, right? And another thing on the VIX, usually it takes about 5 to 15 days for the VIX to revert, and we're probably sitting in backwardation right now in VIX term structure, which means that short-term volatility is way freaking more expensive. So this is also not a good look for the market to go up when the VIX is in backwardation, which means that right now everyone is so uncertain, nobody knows what's going to happen, so everything's expensive. VIX is high. Now it is a premium seller's dream, but there's a lot of risk in selling premium and having undefined risk. Like I've taken some bites. I've got a 460 put on the SPY, a 430 put on the SPY, a 410 put on the SPY. I've got like 335s and 310s in the Qs. I did the Dow. I've got some IWMs at 100. I mean, I've been trading some premium. That $400,000 or $500,000 in cash that I deployed has been mostly selling premium these last like 30 days, which I think those are good probabilities, but there's no guarantees in those trades. And honestly, if I took some ownership, okay, I mean, if I take some ownership, fine. But I'd be owning things at literally like 25, 35% discounts. And if I'm starting there, if I'm starting at 20 to 30% down from all-time highs, pretty excited about what the next, 1, 2, 3, 5 years looks like. Because I can manage if I start at 25% down, I can manage that down to potentially to 40, 50% without really a ton of difficulty. But the upside would be extremely profitable. So, goal for the year, obviously be positive. I was positive until that little jump on Friday, but it's fine. I mean, I'm managing still a single digit drawdown. I can handle that. And, I don't think it's time to be a hero. VIX is still not done. I wouldn't be surprised if we have even wilder extremes. So I just think I keep going back to the same message. Look, I am so hungry to find something good. I want a good trade. Market breadth is beat up so bad. I want something. I think the next 30, 60, 90 days, I've got a window to be bullish, but I just don't have the price action to support it yet. And I hate waiting for it because, in all honesty, you know how this is going to happen. When this market starts to rip, you might be lucky to get one big day in bullishness intraday, and then it's going to be gap higher, gap higher, gap higher, gap higher until the market is done with that. Right? Like that's the one thing I hate about this. So I will probably turn to the futures market to concentrate on something longer term. Like if I'm trading for a 2 to 4 week window, that's not even longer term. I'm talking like a swing trade, I guess. But if I look to futures I can trade anytime. Like I can be like, look, this market's ripping. I'm going to put in a trade at 7 p.m. at night. Well, I can trade that in the futures market. And then the next day the SPY gaps up 3, 4, 5 handles. Cool. Well, I captured a lot of that through futures, and then the market goes and still has some direction as the market's building on that momentum in the short term to to kind of de-risk as the market may be heading up here towards some obvious gaps. Does that make sense? Like this area right here, I really believe that we're going to find it. I really do. Now, this would be area 1, this is area 2, and this 200 moving average would be area 3. What does the bullish pattern look like? Well, it might be something like we settle in at these lows. It could be a aggressive like falling wedge, and then the thing squeezes and just goes. And so if this is confirmation, I want to be in here with some bites. I want to be able to trade. I think futures might be a good way to do it. And all I'm trying to do with the gains that I would make here is reduce the drawdown, have some gains to help me offset, help me de-risk, and just overall control the portfolio. Okay. All right. So anyway, let's go top down. I've just done a lot of talking. Let's go top down. So everything's turning red. S&P is down 0.4%. SPY is down 0.4. XSP, which I think was halted, perhaps. Was it halted? What's this D for? Is that it's not delayed? Quotes delayed by what? You can't give me real time XSP feed? What the hell? What do I pay for, TradingView? Anyway, so this is delayed. SPY turning south. Here is the intraday trade for SPX. I'm out with 2 winners today, which I'm happy with. Price might be choppy. We might come back and hit the lows again. Who knows? I'm not trading in the afternoon. I got burned so hard yesterday. I had 2 winners on the morning, and I positioned for the end of day close to be right around here. So this is a 50.65. I positioned for a 50.40, thinking that's plenty of space. I got smoked on a couple losses yesterday. Lost about $2,000. No, thank you. It didn't have to be like that. But I also was greedy enough, thinking like, oh, the market's gonna stay elevated. We'll gap higher, stay higher. Nope, it gave it all back. So I'm out. I'm out with 2 for 2 and picking my battles. Price action is not suggesting anything bullish. And again, what does this look like? I'm just gonna paint a picture here. Let's use some crayons. So we have this huge volatility swing, and this may be more volatility, right? One way to look at this would be, okay, let's say we have a low and a high. All right. So we either have an opportunity to look to get bullish here with a very tight risk and go all the way back up to the highs again. That to me is a good opportunity, right? Low risk, high reward. And if it doubles with this being 2 lows and maybe a double bottom, double that move. And all of a sudden now we're talking of filling the gap. So it's not a terribly difficult pattern to see, but I would say if we revisit the lows, that's kind of fine. Because if we revisit the lows and close back above, I would be long, stop loss below, go after the same highs and see if this catches some momentum. This may not be until after next week, but I don't know. Maybe it pushes in lows and then CPI kind of saves us with better movement. And if CPI is better, then maybe the market's like, oh, the Fed is going to cut. Maybe they cut sooner, and they speculate. Who knows? But I will be watching price action very closely. All right, so that's our intraday stuff. What else? Equal weight still down. I mean, this is what's surprising. I heard so many people raging about like, oh, equal weight is going to be so much better. It's down 20%. So maybe the broader market comes back stronger, but I mean, honestly, I want Mag 7. I mean, I hate it, but it's like if I was to pick companies that have fundamentally strong balance sheets, Mag 7 is still that group. I mean, and they got beat up so bad this year that I hate to say it, but I kind of like it. And for those traders that are like hating on Mag 7, Mag 7 led us out of the 2022 bear market. Mag 7 was the best performing group in 2024. If it wasn't for Mag 7, the markets wouldn't have hit 20% last year, right? I mean, like the SPY was up 23% year to date for 2024. And I want to say about 19 or 20% of those gains was all because of Mag 7. So how quickly traders forget, like these are good companies and they're offering ridiculous discounts, and I don't think they're going away. So now the valuations are a little bit more in line with what I think is attractive. So I don't mind taking some bites on those companies longer term. Lee, the 10 years, I mean, it's ripped up. It's fading a little bit, but it's still like 60 basis points. I mean, it's fading for the day, but it's still way up there from that bottom. We bottomed out around 3.86. We've come all the way up to 4.5 again. I mean, huge concern. That is a 17% swing in 3 days of trading. And meanwhile, gold is making a nice little rip today. Gold is surging. Again, gold is a great asset to do exactly this. I don't know if gold is surging by itself because I think silver is maybe. I mean, it's kind of stabilizing here. Nothing too great. Copper stabilizing here as well. I mean, I need it to stay above 418. Let me check and see how my copper trades are doing. I'm still down. This is out to the 24th. I mean, I've got enough time to survive this thing, but I mean, I've got a profit trap. Let me check this trade out here. So 1, 2, 3, 4. I think I showed this yesterday in session. Yeah, I mean, I'm okay. There's a profit trap in here. This will be really interesting if I can maintain that profit trap. We stay above 4.18. That is pretty clutch because that'll be potentially like a $500 winner versus a $175 winner. But time will tell. So yeah, gold is doing really well. Silver is responding, at least holding. Okay, but I mean, at this point, silver is either range bound, highs and lows, and maybe it's just going to be range bound for a while, or we come back and revisit this outer trend line, and that is I still think silver is a good trade. It's poor man's gold. It's technically a great setup to still go higher, but that gold to silver ratio has been. I mean, I honestly wouldn't be surprised if this is extreme, right? Like this big breakout we saw with this gold to silver, the ratio has to be on. Other than maybe this little 2020 move, I don't know. I mean, and again, they can both perform well, but gold might outperform, or maybe I'm still not super long gold because of that 200 moving average. I'm still benefiting from all this, but we are crazy overbought. We have a huge extended move over the 200 moving average. I think I'm just going to say this: if we hit a new high in gold, I think it's going to be a topping pattern. I just think it's not going to go too much further, or we consolidate and we have a bit of a maybe a chop fest here. But I'm still waiting for this balance, and I want to get long, and I could be like missing out by these short-term opportunities, but I'm just not being greedy. It's that simple. Okay, China tariffs stick, and part of the Mag 7 struggles recovery. Do you see any other company pick it up? Not really. Not really. I mean, what would pick up the slack? It wouldn't be price appreciation. What would pick up the slack would be what sucks less, right? Consumer staples, utilities, maybe healthcare, maybe financials. Like whatever has the least amount of exposure offshore, whatever has the least amount of exposure with tariff tantrum. So it's going to be very defensive. Your portfolios have to lean. It'll have to be lean very defensive, and bonds aren't giving anybody confidence right now. Like, I mean, the 10-year yield, and look at the 20-year bond. This is awful, right? Almost an 8% swing in 4 trading days. I mean, you'd think if the market's down 20%, bonds would still be able to rip and be some safety net, right? Nope, not yet. Bonds suck. And I mean, honestly, like I'd rather be in like a corporate bond than freaking government bonds right now. That's why I'm like one little trade on TLT. I still wonder if it's good enough, but I mean, maybe we have to come back down and face the pain again and face these lows before it gets better. I don't know. Right. So anyway, all right, let's keep going. So equal weight not performing much better. Nasdaq peak to trough. I think we had like a 27% high to low. 25% on NDX. I think futures was down a little bit more than that. So here's NQ. NQ from all-time highs. NQ was at 26.5%. So, I mean, the argument is bear market territory in the NASDAQ, but if you traded the NASDAQ at all since the 90s, it's one of the most volatile but most resilient indexes that we've ever had. And it is by far the best performer. If you go Qs versus SPY, the chart looks ridiculous over 30 years. Qs are up here, SPY's up here, and it's an outperformance of like thousands of percent. So, and then you put bonds flat. So anyway, it's volatile. I mean, the 20-30% pullbacks in SPY come with 30-40%, 50% pullbacks in Nasdaq. It was down 80% during the dot-com bubble. So yeah, it's not easy. But this tends to be the most like ridiculously reflexive and resilient index because, we are a tech economy. We are service and tech. It makes me nervous that we want to go manufacturing because I think that is not our business model anymore. So who knows? Dow Dow should be a relatively safe index just because it's supposed to be less volatility. But again, how much exposure do these companies have to tariffs? Well, right now it's showing like everything's down. I mean, this is not performing well. It's down a little bit less than the others, but from recent highs to lows, I mean, the Dow's down 18.7%, right, from high to low. Like that's potentially crossing bear market territory as well. Russell, the worst of the worst. The Russell, however, I did sell so much premium on the Russell that these blue lines down here, the 105 and 100, this is where I would say if I'm taking ownership of the Russell, it's right here. I literally had premium where it's like $1,000 winner if price does not come to 105 by the end of the year. So I mean, again, if we're going to start finding some lows around these 20% levels, does this support hold? And if so, well, yeah, we'll range. Russell's probably one of the best looking catch-up trades. I think it offers some good, it gives offers some really good reward to risk. If it goes up, I think this moves better and faster, and it probably outperforms. Once the Fed starts cutting rates, I think that's a good thing for small business as well, which is what your Russell is essentially made up of. But my concern on the Russell is that this is a potential and pretty nasty looking double top. So if we don't hold this level and we break, bye-bye to Russell. And we're coming back to COVID lows, and I'm going to scoop it up and I'll own this thing and I'll flip it around for, hopefully 50, 60, 70 bucks per share because it's cheap enough to own an index for $100. That's crazy. But it's not going to be easy. It's not going to be fun. And I'll take on all the heat for my undefined risk trades that I have. But if it holds here, well, fine. We can chop around here and it's not easy. And then the catch up trade is we get back to all time highs, right? Like I was bullish on the Russell. Once we had this high here, I was bullish on that swing, got paid pretty well. But now it's bear market. Okay. VIX, like I said, very persistent. This isn't just a one-off volatility event. VIX is still very sticky. So extremely high volatility, which makes sense. There's a ton of uncertainty out there. As tempting as it is to just sell a bunch of premium, which I tend to do, I'm trying to sell things that I'm like willing to own. And I put that in the Pulver alerts, like ratio spread, willing to own. Here's the break even. Probability of profit's pretty high, but still, it's like if I take some assignment, I'm taking some assignment on stocks that I really want to have in the portfolio and I'm willing to repair. Doesn't mean the trade's going to be awesome. Doesn't mean I'm enjoying like getting assigned on multiple, whatever prices are. It's like 100 shares is 100 shares. That adds up. So if I'm assigned on, 5 trades or 10 trades, like I've got to have the buying power for it, which fortunately I do. But it's mostly I want to repair. I'm not looking to own long term. I don't think I really want to own anything long term. So anyway, dollar indexes come back down to the lows or close to the lows. That's fine. I was thinking this was a pullback into some pocket activity at best. So this was like the first area that still didn't get hit yet. This pocket level still didn't get hit yet. So dollar returning, it's fine. I can see the dollar doing something like this, another low, a lot of chop in here, maybe one more push to the downside, and then we see a bottoming pattern if the dollar holds. I know this administration probably wants to see a way weaker dollar. So if we break 100 handle, dollars going in the toilet, and that would be a pretty nasty move. But you can see technically, like it could happen if we break this structure right around that 100 handle. I mean, we could be coming back into these like 2021 and 17 lows. That's a big nasty move on the dollar. But fundamentally in currencies, that could be a wild ride. Oil 56. Holy shnikes. We got oil at 56.28. Dropping like it's hot. Oil futures 56. I thought 60 would be a pretty firm handle. This is going to put a lot of pressure on drillers. This is going to put a lot of pressure on energy. Oil, for the most part, is not profitable below $60. So I could see them pushing back. I mean, this, again, administration wants drill, baby, drill. Why would you drill at 56 when up here you could drill at 80? Like they're not incentivized. And again, I think this could be an interesting like pushback from the energy industry. UNG, I'm still long UNG. This may come back to bite me in the asses as well. So I'm still out to 2027 on this, so it's not really a huge deal. I still think this is a pretty good looking bullish pattern, but this level here, a head and shoulders or a crown pattern, maybe settling back in for a swing trade, or just resets. And I am part of the Widowmaker gang, which is you can't trade UNG and make any money. All right, gold, everyone's favorite. I haven't heard anybody talking about gold today, which is kind of weird. Just kidding. It's like all I see in the chat. I get it. It's up. Okay, gold is up, but I'm telling you, don't get too excited about gold being up, because if we hit highs, I think they're false highs. If we go exponential in gold, and this is where I would say I'm moving stop losses. I own GLD. I've got trades on GC. If we go exponential, and this looks like a lumber chart or a cocoa chart or a orange juice chart, like those are the silly things that this market's done over the last couple of years. If it looks broken, move your stop losses and trail, and eventually this crashes. But if gold is just up and it's going to chop around here, technically speaking, there's still room to come back here and find corrections. So I don't see gold running super, super high. I don't see it crashing all the way down without getting bought up. So, I mean, this is what I've just been patiently waiting for. I want to buy gold back here. Area 1 at the 200 moving average. Area 2 at this outer trend line. These are good areas to me. These are huge discounts on gold. And it's saying so bid and so consistent, like I'm not getting those pullbacks. But consolidation that maybe pokes and fakes, like that's a good trade. I just can't justify buying all-time highs. And this little tiny pullback for 3 days is not like buy gold. I'm not that trader. So I'm going to wait. I'm going to be patient. Yeah, Igor, I disagree, because this is not straight up. You want to see straight up? This is straight up. Okay. Straight up is this. If gold looks like this, then you can tell me that we're straight up. Okay. That's straight up. Gold is not doing that. We've had a healthy bull market that's likely going to have to come back for some type of ABC. Like there's just better structure and technicals in gold. If it starts to look straight up, guess what? I'm still long gold. So it's not like I'm, shooting myself in the foot here. I'm just letting the melt up happen. If it's going to keep melting up and get exponential, great. I'll benefit from that. But I will get overly protective when we start getting what looks to be a broken chart. Okay. I'm sorry. I don't understand. I'm stupid. Okay. Look, cocoa was this. Gold, wave, wave, wave.
Hey, Chris.
What's up, dude?
Hey, why are you fighting with people in the chat?
Igor is just a gold bull. I can tell. I'm just trying to call the technicals. It's like I've said this from literally day one this year. It's like I want to buy gold. I want a dip. I'm waiting for a dip, and I'm going to hold that line. So it's like I think there's better opportunities. The problem is the whole world's wanting to buy gold, but also at some point that's also a crowded trade. So just be careful. That's all. A pullback's great, but I'm just not
actually
crazy bullish.
On the gold thought too. I am currently long, but this morning I actually trimmed my stop loss just a little bit for exactly what you're saying. Yeah, I'm long. Hey, this is keeping me alive right now. Gold, I owe gold like I don't know, a couple several
your
percent.
Lifeline?
Yeah. It's been really good. I think I'm down. We've been keeping each other updated. I guess needle is moving like crazy today because market's so volatile, but I think I'm probably down 5.5% year to date now.
Okay.
And largely saved by gold bullishness and just riding, as you're saying, riding that momentum. Is it due for a larger pullback at some point? Yes. But Chris, let me get your thoughts on this. Gold selling off. Does that happen if we get trade negotiations positively? Or if you think about this, when COVID happened, right? What did gold do? It sold initially for the margin grab that globally, big funds needed that initial grab of cash, and they took it from everything, including gold. But gold was back to the highs within a few weeks. It's almost like the first place I would think, this is my best guess, and part of the reason why I am long gold and would like to stay long gold. You had that initial crash, rallied back because that was the first place people felt comfortable going back into. So with this trade war stuff, even if there's some positive headlines, my question would it be people say like, okay, well, we'll get back into some stuff, but maybe the first place they go to is gold. I don't know. That's my fire from the hip idea.
Sure. Well, I'll say this: if we have a similar play as COVID, look, if this gets hit, I'm buying gold. It's that simple. And what's funny is like as this is falling, everyone's going to be panicking, like gold is crashing, and it's like
Mm-hmm.
you buy it and it's right back up to the highs.
Mm-hmm.
So I mean, it's one of those environments where we are seeing some very wacky price action, and I wouldn't be surprised. I don't know what the catalyst would be to cause it, and maybe it doesn't happen. But if there is, I mean, we're creeping up on. We've got to be close to 400 bars now, Nick, and that is a
Yeah.
long ways on a daily time frame. So let me just measure real quick, and I'll do this. I'm going to set chart alarms. We're at 383 bars. I'm going to set a chart alarm. Any activated chart alarm here at this 144. So just add an alert, close. Add an alert on the 200, close. Because
Yeah.
the first thing I'll do is when that hits, I'm going GC futures and I'm going GLD again, and I'll add to my position like I've been talking about now for months. But I'm not going to buy when we're sitting here on gold about 2% away, 3% away from all time highs.
No, I don't blame you at all.
So
I think,
I'm not.
that's the thing is like, I look at gold right now and against my better judgment, right? My better judgment has been like, okay, I think we're going to get some positive headlines. I've been wrong several times on equities in a row. Like one of the things that I thought was, okay, Trump is going to come out with tariffs, but they're not going to be these overwhelmingly sweeping tariffs. They're going to be, more poised towards negotiation. Not the case, right? Super
Right.
sweeping tariffs and super aggressive. And that's been a persistent theme. But the reason I'm bringing that up is because although I've been kind of wrong on that idea, my system, right, my personal approach, and I encourage everybody who's listening, Chris, you have your system, I have my system, everybody who's in the audience, have a system, have a reason, because systematically I was staying with gold, riding gold, and that's been, a game changer for me. Chris,
Right.
I'm sure you have many self-defense measurements within what you do to help protect a portfolio, even if
Yeah.
sometimes it doesn't feel right to do, like even if like your gut is saying one thing, but your system is saying another. I know a big thing. Maybe this is what you're headed towards, but big thing that you do is you are very focused on diversification. You're spread
Yep.
out. You're
Yep.
not all in on one idea, and you're pretty agnostic to what market movements do. I mean, you're not super speculative, which I really admire about your approach. Like you're more focused on premiums.
Yeah, it's more mechanical. I mean,
Yeah.
this is my defense right here. Like this is what's allowed me to enable or maintain about a single digit drawdown through all this crap, and also be sitting on a lot of profit in these hedges. So these are all protective plays, right? ES hedges, MES hedges, SPY hedge, FXY is Japanese yen. I'm long that. I also did 6J, which I already got out of that trade for a nice little like 200% winner.
Mm-hmm.
GLD, I'm still long. I want to get back into GC because I like the futures plays as well.
Mm.
CEF is a gold and silver play. PHYS is a gold and silver play. This is where I'm hiding out. I've been tempted to look at like the defensive sectors for the U.S. like going in more into healthcare, going in more into utilities, but you don't get the price appreciation in those, and the premiums are absolute trash. So
Yeah.
if I wanted to like sell puts on XLU, you get nothing for those. If I want to buy a stock in XLU, you're not going to get any price appreciation. At best, you're going to get maybe a stock that doesn't go down, or maybe a stock that goes down less. I mean,
Yeah.
and this is the crappy part. Like just like in 2022, which is that was a controlled, orderly bear market. But if you go year to date here, all this shows me is that there's no real safe place to hide. And right now,
Mm.
Nick, bonds aren't even offering safe haven either. We've had an
I,
8% swing in TLT.
I have to ask you about that, Chris. I have my speculations, but I think China's offloading. I sent you that message this morning. I think
Yeah,
China might be tanking or just closing out. I mean, they already had been selling bonds, but we might have accelerated that trend with what clearly seems to be like the closest thing to not firing bullets and starting a war, right? There's a
sure.
straight up trade war going on. And so if we have, Chinese assets, we'd probably want to sell those. And the Chinese vice versa would be like, get rid of the American assets. We can't, that's super dangerous territory for us. And then meanwhile, we got gold shooting up today. So it's almost like, to me, the writing's on the wall that Central Bank of China has already been buying gold. We might have just accelerated that trade.
Yeah, it's true. I mean, right now, I just want to put this in perspective because right now it's like China's offloading, Japan's offload. Maybe they
Mhm.
are, but
Yep.
this is the reality. We still own like 85 to 87% of our debt. So the
That's true.
offloading, it sucks. I get it, but like, because we're watching, frenemies become enemies and allies possibly switch sides and alliances. Maybe like that's what I think this is the worst case scenario. Like if we're getting worst case scenario, it's like we are going to be what Jamie Dimon said yesterday, which is he had a great quote. It said, "America first is fine, but America alone is not." Paraphrasing, but it's like, I mean, that isolationism is not going to be good for the U.S. because we might find ourselves, like just yelling at the world and nobody's listening. And meanwhile, we're sitting here with like this ticking time bomb of debt that needs to be I mean, and there's you can argue for a lot of cases like something like this needed to happen. This is Ray Dalio's changing world order. This is the fiscal cliff, the fourth turning. Like all these things are out there. This is the fiat system really being stressed. And so, I mean, look, man, there's nibbles here for Bitcoin enthusiasts. There's nibbles here for Igor and gold bulls. There's people that like what bond king. I mean, like, what's his name? Bill Gross,
Unlock.
but like PIMCO, Bill
Couple of them.
Gross, like he no longer works for PIMCO. Like
Mm.
bonds have not been easy, and they've been like garbage in the portfolio. Like bonds are not good. Bonds have been in a 3 to 4 year drawdown. The only time they were rescued was that late Q4 rally in 2023, coming back from like another bear market, and they ripped up like 17% to finish positive on the year. But they have been in a 4-year bear market. And
Well, and bear market, Chris, is lenient. I mean, they've crashed. They've
absolutely.
completely done destroyed. Yeah.
Yeah. So I just want to show this because like US still owns its debt. And, the scary part is, yes, if all of a sudden the US loses world reserve status or gets to get like knocked to world number 2, then maybe this changes. But I don't know. And it's like, I hate that I'm even thinking like so doom and gloom, but it's like, look, man, if this market, I do believe this, the financial markets are too big to fail in a way. Like there could be some restructuring, there could be some massive reset, but in some way, shape, or form, financial markets are too big to fail. There's too much wealth for the entire world, and you can see based on the price action from Friday last week to what we're seeing right now, everything is red. The whole world is red. And if anyone cares about the financial markets globally, they're going to find ways to figure it out.
Yeah.
And it's not easy. Like it could come with a lot more pain, but it certainly comes with a lot more uncertainty. And this is probably one of the more annoying times I've had in my career. Like 2022 was challenging, but it wasn't this annoying because it's like, holy crap, are we just going to like what's next? We go 20% and it's like, what's next? 30, 40? Like we just
Mhm.
go all in one straight line. It's like, I don't think the market does that, which is why I kept emphasizing maybe this little like April 17th expiration. You're dealing with one of the most bullish windows in the markets, like seasonality wise from April, May, June,
Yeah.
July, historically very bullish. And if we
Well,
can just survive this window to not do too much damage and the market's priced in essentially what is kind of this, trade war worst case has kind of been priced in. Now the next shoe to drop, like I said, would be earnings compression, which then maybe later this year is going to be jobs and labor if we have like a big September, December dump in unemployment. But I don't think it happens all at once. And so, but it's not out of the cards, man. Like I don't know if 4,800 is the low in the S&P. I think that maybe it's closer to 45, maybe it's closer to 4,000.
Mhm.
But I'm not going to sit here and trade that way right now. I just know that I've got hedges out to December and see what happens.
Yeah, and I guess Chris, just to lay out kind of like since the last time we've spoken, the only stuff I'm doing when it comes to stocks and indices at this time, as you probably could guess, I'm just dollar cost averaging on stuff that I like
Yep.
super long term.
Yep.
But there is no, I got my comment section. I'm not sure if you have seen some of this too. Well, you saw earlier, right? Comments, people are up in arms, people are angry, people are upset. There's a lot of people losing a lot of money. It's a natural environment. It's a volatile environment. And I think we talked about survivability. That really stuck with me all week. Our conversation just about like the goal here is only to survive. Like so many people out there. I mean, you can try and like get cute and try and thrive in this environment, but the problem is if you want to thrive in this environment, you're short. And you're short in a time where, as you were discussing earlier, premiums are off the chart. You want to buy any options right now. They're very expensive to do so. So you have to be really careful trying to be a hero in this market. I think really playing defense, being modest, and just saying what you said, basically, look, markets are too big to fail. And in the long term, I think human ingenuity, which has gotten us out of everything in the past, will eventually prevail. We'll find some middle grounds, we'll find peace. But again, it can always take longer than we think. Just because the bears would say, well, Nick, yeah, that's great, but maybe we have 2 more years of this, and maybe there's way better prices ahead if you have the patience to wait out. That's again why I go back to my stance of dollar cost averaging. I'm not all in today with unwillingness to admit that we could go lower. It's, I'm diving in. And also just a quick note to everybody who is not retired. This is a good thing. Do not let this confuse you in terms of your long-term personal opportunities. If you are somebody who invests passively, or if you are somebody who's looking, if you have more income than expenses, as long as you keep your job, fingers crossed, let's hope that is the case. This is a long-term good thing. Don't let it freak you out. Don't panic. Just stick to the systems that you're using. And again, don't make dumb decisions.
Yeah, it is. I mean, it's survival, and nobody look. We've been spoiled for many years now on every time the market's down, 5%, it's bought the dip. Every time it's down 10%, immediately bought the dip. V bottoms have been what traders have seen for the last 5+ years. This is going to be like a trough. We're going to have to find a bottom, and like I said, this might be something a little bit more dramatic, where it is a high, low. It's maybe a range trade that kind of gets us really shaken. It's like, what's going to happen? I could see a bear trap, and I would be willing to kind of take some stabs at longs there. Or this becomes something where maybe it's a fresh low and another fresh low and another fresh low, becomes like a falling wedge. But if we're patient, Nick, like I think between our powers combined and guests you have on the show, it's like we'll be watching this stuff, and I will take defined risk plays. And if I feel like the coast is clear, I can be a little bit more aggressive on the timing of these. But I just think right now, I've traded long enough that I have restraint, I have discipline, and as much as I want to say, how excited I was to see that the 50-day moving average, that S5D, whatever that, I can't fucking remember the name of that thing. the 50-day moving average market breadth indicator they keep referencing, this one.
Yes. I watched your segment on that earlier. That was great.
Yeah. Like I have not seen this hit in so long. Let me go to this guy here. Fudge. I haven't seen that since 2022.
Correlated selling is off the charts right now. Like uniform, man. Dow Jones, Nasdaq, and S&P have been moving in lockstep. That's very rare.
And even equal weight is no better. Like, so there's just not like, look, there's not a lot of places to hide. This proves it right here. Somebody wants to tell me, oh, this is about rotation. It's like, bullshit. It's about rotation. This is a crappy market and nothing's good. And the only way you're going to hide out is if you want things to hurt less, then hide out in consumer staples and stop worrying about it, because it'll be fine. But it's not going to necessarily be a bull market. It's just going to be preservation of capital. You want to hide out in utilities, it's fine. It's not going to go anywhere, but it's going to go down less because it's way less correlated and way lower beta. You want to hide out in healthcare. I mean, healthcare might have some surprisingly good price appreciation because
you get some dividends.
Sure, all of them get dividends, but you pay tax on dividends. But I'm saying, like, utilities aren't going to do anything price appreciation wise. Maybe they will, maybe they won't. But healthcare has an interesting mix because there is an AI element to healthcare. It's one of the fastest growing sectors in the world. It's like our baby boomers that need this care. I mean, the healthcare costs are just rising like crazy. The need for right now, the need for nurses, doctors, people in the field. My concern is over the next 5 or 10 years, AI starts doing more of this. Like, think about all your symptoms put into an AI machine, and it's basically the people cares, like HR, maybe like one HR person to run a department to handle all these. Like
another one, Chris, with that same line of thinking that I really like for the long term is medical device companies, Medtronic, Intuitive Surgical. I mean, some of these companies like Intuitive Surgical is very, very expensive stock, but know what you're saying. The whole medical world is like ripe for AI to seriously level up humankind. I mean, that is some really practical stuff. Healthcare was a big favorite for me personally going into this year. Now, I got to disclaim, if I was really smart, I would have had most of my portfolio, and I did not. But I did have plenty of healthcare stocks going into this year and continue to like that as a potential outperformer. So far, it's doing pretty well. But what you're pointing out here with this breadth thing here, right? Just basically everything moving together. I think it's reasonable. I've been talking about this, Chris, and I've heard you leaning more cautious here recently too. With this big kind of market downturn, it's also fair to acknowledge bounces can be very violent, right? I mean, we had just a massive turnaround the last 2 days, and then of course down again, and then what you're pointing out there, everything kind of uniformly down. Does that give you like the theory that like, okay, probably looking a little oversold in the short run, maybe more pain ahead? Or do you think you ignore this trend this time? I feel like you kind of have to look at this thing and say, look, it's had a great track record, innocent until proven guilty.
I think so. I've been looking mostly on like the weeklies and monthlies because it's so rare to see them.
Hmm.
But what I'm looking at probably on the daily is if I see a green close, I'm probably going to take a little bite. I'm willing to take a bite because and all I need is like a 2 week to 4 week window because that's usually about if we are in a bull rally in a bear market environment, then a 2 week rally or 2 week recovery could be surprisingly bullish. Like, and that's what catches everyone off guard is, I mean, if we clear this high here, Nick, if we clear 5260 here on the SPX,
Hmm.
we could rip all the way up here to 5400. We could rip all the way up here into 5600. And it's going to catch everyone's, like, it's going to rip everyone's face off with how aggressive that is. And then the bears are going to be like, hey, that was cute. Now we're going to go right back down.
I was going to say,
You
in
know?
2022, look at what you had. You had some of these. Maybe we can share my screen here for a second, guys. We
Yeah.
had just a violent down move, up move, down move, up move.
Double digit swings the whole way
Yeah.
for 2020.
And this move, that's 24%. Doesn't look like that, but it's 24% move up, right? And then this move was, 17, 16%. So I think that it's really important that I've just been seeing people who are now thinking, Chris, that the easy money is just being short. And I think that's such a dangerous mentality because shorting is inevitably, in my opinion, one of the hardest trades to get right on the indices because it's so short-lived, so sharp, and you can take profits way too soon. It's just very, very difficult to the windows are so narrow, but the profits are so big if you're right.
Yeah. I mean, and that's why, like, the way that I hedge is it's a cost of doing business. It helps me protect the portfolio. I have to do it in increments. I mean, this was definitely more of like a strategic hedge because I was pretty bearish going into the start of the year, like at least expecting a correction. So we got it, and we had more than that, obviously, with this flush down. But getting bearish at a 65 VIX is insane to me because
Yeah.
everything is so expensive to do so. I mean, I'm very lucky that the hedges that I put in place are after this flush and this retracement. I put in hedges that are
Yep.
essentially the rest of the year. I'm like, no funny business here. If we're dealing with a bunch of nonsense and we don't get back to these highs again, I want to make sure these hedges are in place. So, I mean, I'm sitting at a good chunk of profit. If it gets worse, if we stay down here, we just keep like troughing these lows and keep hitting these levels over and over again, or like the bottom falls out again. And I
Mhm.
said this on this chart, dude. This is not a good spot. Like, technically, this would be a very scary area for the overall market because if we break this spot, this level is wide freaking open to reset all the way back into the lows of 2023 and maybe even back down to the lows towards 2022. And
Yeah.
that, I mean, that is probably the worst case scenario in my opinion, is like we wouldn't go too much lower than like 3,000. But you talk about a percentage. I mean, we're already talking like historical type movements of how fast we got to 22%. But on top of that, you go 51% down. I mean, that is a full on economic reset. And what almost feels like could have been avoided, maybe
Mm.
could have been handled differently. So I think that's what's so frustrating about this. Is like, does it have to play out this way? And some people argue, yep, it had to. The US was heading towards a fiscal cliff. It's got to happen. But I don't know. I mean, I guess because we do this all day, every day, it's like, I don't think it had to play out this way. It could have been a little bit more uniform, but nope. I guess it's it's not just a band-aid. It's sever the arm and sever the leg,
Yeah.
and maybe you're limping in with no limbs at all. But it's like, if that's what it is, guess what? There's going to be buying opportunities, Nick. At some point, if we get this level to go up or we get this level to go up, then there's wealth and wealth and wealth to be made.
Well,
But
and Chris,
again, you don't survive that, you don't trade.
if 3 years from now the market has stabilized, now of course 3 years from now the market could be lower from that. Yeah, I'm not saying it's a certainty, but
Yeah.
if 3 years from now we get some normalization out there, we get some resolutions, we get some compromises, we get some better than expected, better than worst case scenarios, right? If that starts to play out over time, not saying immediately, Trump might have to get out of his system for a while, I don't know, but if eventually we find ways to move past this and move forward, the thing is, nobody's going to ask you if your account. I mean, of course, for most people, nobody's looking at their account, but for you and I, Chris, we're in the public eye, right? People are watching what we're doing,
Yeah.
so we can make. I've gotten slammed for being wrong on this might be a bottom and all this. But at the end of
Sure.
the day, if I'm accumulating shares slowly without leverage,
Uh-huh.
in 3 years, if the market's up here, nobody's going to ask if I caught the bottom or not. They're just going
Exactly.
to ask, how'd you do overall? And I think that
Yep.
your risk to reward gets better as stocks go down, whether people like it or not. There's so many people out there calling for a way bigger crash. But to your credit, if you're bearish, that's how professionals play it. They wait for these moves. They're
Yep.
not shorting here
Right.
saying, yeah, this is it, time's up, game over, stocks to zero.
Yep.
That is hype and gambling and foolishness to the highest degree in financial markets. You have to be really careful not to chase, even if you're bearish. Again, I think that there's way better. You asked me about this the other day.
Yep.
Isn't that a way better looking risk to reward? Absolutely. If you're
Yep.
bearish, you have good reason to be. Your strategy says so. The risk to reward, in my opinion, is way better here because what's going to come with this? Put to call ratio is going to look a lot cleaner. VIX is going to look a lot cleaner. You're
Yep.
not going to be paying an arm and a leg to buy puts.
Exactly. And those are exactly the levels that I would like to see. Number one, I'm agile enough that I'd like to see the short-term ability to get there. So we
Mm,
have that little rally to get there. I'd love to be bullish and take some, little short-term income trades. But once we get there, it's like, yeah, I'll see that the VIX has probably been smashed all the way back down into the 20s. We
mhm.
might have some elevated VIX here, but I mean, 2022, the VIX was between like 20 and 35 the entire year. Now this is more of like an outlier. We're getting like the top 5 VIXs of all time, I think, as far as peaks. We're getting, one of the bigger single day moves in the top 3 or top 5, like whatever. It doesn't freaking matter. It's like,
Yeah.
there's no reason for it to also stop. I mean, I see Pimp's comment, like I talk about Charlie Bolello, he's a good data guy. And like, him, he does creative planning. But just to say like, well, every time this has happened in the past, it's like, right, until the black swan runs the VIX up to 100, until
Mhm.
the black swan runs the VIX into 150, and it doesn't make any sense to anybody. But it's like there's nothing that makes this be, or there's nothing that guarantees that it has to stop at
Yeah,
65.
you never say never. Look at,
Exactly.
Japan's market. There was like 30 years where you got back to break even. So it
1989 to
can happen.
2024 drawdown.
And you might
Imagine
say,
that.
well, haha, it came back. Well, yes, 30 years has gone by,
Yeah,
right?
you and I would be like, I want to be retired, and I'm still
Yeah.
waiting to get back to my all-time
Yeah.
highs.
Just trying to get
Yeah,
back to
that
break
would
even.
that would be
Meanwhile,
lame.
inflation is still there.
But yeah, but if anybody wants to know the lesson of dollar cost averaging, show them a chart on Nikkei 225. Because from
Yes.
1989 to 2024, if all you did was dollar cost average, I did an example of that, and the returns you make, yeah, granted, it's a long time investment, but the returns you made over that course, it's like you basically built your position up on the way down and the way up, and you're sitting like, I don't know, close to 5x your wealth on the way back up.
Mm.
It did take time, but it still annualized out to be a pretty darn good return. It just was a crappy wild way to do it.
Well, think about too, in terms of that vouching for dollar cost averaging, right?
Mhm.
Sometimes you see those studies, and these drive me crazy. I don't know if they drive you crazy, Chris, but drives me crazy when I see studies of people saying like, "Oh, just lump sum invest. It's so much better." Well, yes, in an environment for the last 20 years for the Nasdaq and the S&P 500, which have gone pretty much straight up for
Mhm.
a number of years, yeah, nothing's going to beat lump sum investing. But if you ask somebody in Japan who's 60 years old right now, they might have a very different answer and say, "Look, I used my income and just bought in at lower prices on great companies and actually ended up doing okay, rebounded my portfolio way sooner had I just put it all in right before the big crash." Right. So
Oof.
just
Lump sum at
something to think
all-time
about.
highs. That'd feel really good, right?
Yeah. Yeah. Exactly.
Yeah.
That would
Well, and I
be
was gonna
rough.
say, and dollar cost averaging too is an index play rather than a stock play.
Yep.
I never love. I mean, I never love dollar cost averaging into stocks unless you firmly believe that that stock is in a moat, has this huge advantage. But crazy statistics is over the last like 30, 40 years, if you dollar cost average into stocks, the performance is usually terrible. Like
Mm.
somehow the stock pickers of the world, if you don't get it with like the right run, it comes back and resets. A good example would be Meta, because Meta for almost a decade returned nothing. Because we
Mm.
had, I mean, even looking at it now, it's like you go back to Meta here when it was, let's say from 2017. Okay, it's just a silly example here, but from 2017, you had a 200% return on Meta, and then in 2022, you lost everything. So, I mean, if you're going to dollar cost average, sure, but after 4 years of holding a stock, you're back to zero and possibly negative because of your dollar cost average. You're adding to higher highs,
Yeah.
and you lose all of it. So you're sitting in a huge position in the downturn, and then you get this. And again, I can see the argument being made like, well, it's still, but dude, I don't want to hold anything for 4 years and be flat or negative.
Mm-mm.
So an index to me is like you can participate from Meta being great, you can participate from Palantir being great, participate with whatever stock is going to be the greatest thing ever this year, if there's anything. Participate in an index that catches that move. And I know it's a fraction of what the performance is. Like Palantir last year was what, 300+%,
Mm-hmm.
best performing stock in the S&P, but it also comes with a 40, 50, 60, 70% drawdown.
Yep.
And it's like the index, it's like, dude, we're down 21%. And it feels like the worst case scenario. And it's not, but 21% is manageable compared to a stock that's down 70%, 80%, 90%. Because to me, and I have a lot of traders that do this. Somebody told me like just last week, like, hey, Chris, what about NIO? Chinese EV play at $3. I'm like, okay, man, at some point this stock was from basically $2 to $64 seemed like the greatest thing ever. Look at it now. This to me is dead capital. I don't care if I had 100 of these stocks. If 99% of them didn't pay out, that one that may be a winner could maybe get you to break even if you're lucky. But it's like, that's not, I don't want to lose 99 trades to make one winner. And that's just
NIO
my style.
is a great example, Chris, because I remember, the hype around this. Oh, this is the Chinese competitor to Tesla,
Right.
and it's going to take over, and that's the thing is even, and here's another one is Cisco, right? That's the classic example of here was many of us, myself included, were not trading at the time that this was the hype machine that it was back in 2000. But I mean,
still
guys, this was the NVIDIA of the time. Like, understand, like this was the unbeatable, undisputable, moated and goated king in the stock market, right? And what happened? Well, it crashed and gave back all of its gains and took, many, many years. I don't even know. Yeah, I mean, it got back. I mean, it's still at the same point right now as it was 9,000 days. Yeah.
It took over a decade to get any traction to even start coming off of those lows from 01. Decade. And not only that, but a decade that you lost 80% of your money.
Well, and the average person that was buying this, Chris, the average person that was buying this was definitely not dollar cost averaging on the way down, right? They were getting either destroyed completely, lost all their money. Like that person was not as practical as people who, maybe who have bought Cisco after the fact and maybe have done well with it, but
maybe.
It's just, you have to be so careful in these markets. There's winners and there's losers. And, what I found is your risk reward just gets a lot more attractive when you wait patiently for opportunities to come to you.
Agree. And, look, if it was easy, everybody would do it. And if it was easy, everyone would be a Stanley Druckenmiller, a Jim Simons, Bill Ackman, Warren Buffett. Like, they're not. Nobody is, right? It's like, and honestly, if a good book to read for anybody would be Market Wizards. You will see that there's a common thread with all of those people that are in that book from Jack Schwager. They all have like a very fortunate window that if they're humble enough, they'll acknowledge it, but their fortune was made in a very brave call that set them up for their entire legacy. Like Stanley Druckenmiller that ended up working with George Soros, like he put like 70% of his entire portfolio in oil in one. And he was a genius, and he did this for like 3 or 4 times over a decade. And it was like all in like 70-30, 80-20. And he was right. But I was like, all it took, again, I'm not like faulting the guys. Like Stanley Druckenmiller is amazing, but if he was wrong, you would never hear of him.
Yeah, no, that's true. And like how many people did you never hear about that did something like that? It's like same thing with George Soros with, the Bank of England, the British pound. I mean, these were trades and Warren Buffett, 2008. I mean, these were notorious trades, although Warren Buffett has been just so impressive. I mean, even now went heavy cash before all this. That's just pretty incredible. The dude is he's done it so many times. He clearly, I don't think Warren Buffett, he doesn't say that he tries to time the market or he doesn't get bearish on the market, doesn't time it. But in a way, he kind of does because he knows times when it's good to be buying stocks and he knows times when stocks are likely too expensive. And although that doesn't come down to, okay, here's the hour that it's going to turn bearish or bullish, it does generally lend towards this time, this environment is not right for buying, and this time is more attractive for buying.
Yeah, and and look at how much like crap he was getting for being a net seller in Q3 2024, Q4 2024. It's like, yeah, he was a quarter or two early with like raising capital and raising cash, and I mean taking. I mean, that's I think one of the highest percentages of assets I've ever done in cash and non-allocated, which was around 20%. But he did it. I mean, one could argue as far as timing the market, maybe 1 or 2 quarters earlier, but he looks like a genius now because he's probably exposed to none of this. And I mean, there's still ownership, and obviously some positions are still getting beat up a little bit. But I mean, as a value investor, okay, they've got 20% of their overall assets in cash waiting to say, yeah, we could buy some more of this. And maybe it's a dividend play. Maybe it's I mean, they can do whatever they want. And honestly, when they do start taking positions and stuff, they will manipulate it. I mean, everyone's excited about Berkshire Hathaway buying something. But even their stock, it's like this also was a bar count. This is another reason I'm not super long on gold, Nick, because this was a bar count that was just like the S&P, and we actually came down. You can see how quickly this came down to the 200 moving average after a bar count of 360 bars. We're at 380 bars right now on gold. So I don't know what's going to cause it, but I do think that something creates this. I mean, I don't know, man. Maybe it is like that. It could be some weird China US going head to head, super disruptive like event, and then some wild V bottom that comes out of it, and maybe gold is hitting that 200 moving average. Maybe the S&P flushes another 5-10%, but there's a V bottom. Like that's also the reason that like I've got to be disciplined, show some restraint, and wait and see. Like if an opportunity like that happens, like I definitely want to be able to like take some courageous jumps into that environment, as opposed to I think we're gonna have a bottomish here. Maybe we do, maybe we don't. But those outlier opportunities are few and far between. But when you get them, that's where like surprisingly like short term gains can be made, but also like the bottom could be in type thing, and
Chris,
could be worth.
What do you think about currencies right now? What do you think about the dollar? Like it's kind of a tricky one for me. The dollar is interesting. Like, is it going to play global reserve again?
I don't know.
Are people bailing on the dollar? That it's interesting. You got euro making. I mean, these charts look strong.
What's going to take place though?
Yeah.
Don't tell me Bitcoin. Don't tell me it's like is the currency market at $5 trillion a day going to be replaced because the dollar's losing status? It's like the dollar is everywhere, and it would to me it's the currency market. It would take 5 to 10 years, I think, to replace the dollar.
Easily.
And so, I mean, I think that the way the dollar has behaved these last couple of months with this, especially this like March sell-off into now, I still think the structure, you've got some strong 2-year structure here that goes back into this first wave down into like 2023. And then it's clearly this like 101 to 100 area has been a noisy level, but also a very firm level of support. So I wouldn't be surprised if, there's some drama getting priced in here. The dollar is going to bounce in some way. I mean, I'm actually looking at, okay, so if it's not the dollar as far as currency pairs behave, is it the yen? Do you trust that the yen is going to be like this safe haven? Everyone's flooding into the yen. It's straight risk off, but the yen is also not immune. I mean, right now the Swiss is like the better safe haven of all the currencies, and I kind of hate it because obviously I'm enjoying my carry trades and watching those things being fresh lows. So, but we almost in a way had a bit of a kind of a flash crash type event. I mean, that was a 3 to 4 day extreme that I think in the, let's say, medium term, we'll find a way in the currency land to find some bottoms, make its way back up into a pocket. And my goal is to, this is my break even right here. So I build it back into this pocket. I make some money. I'm not trying to hold these things forever, but this is such a disruptive move in the currency market where just like you see, that move balanced like 50 to 60% of it. This move here is probably going to pull back 50, 60 or all of it because historical lows, lots of structure in here. You look left, it's like there's tons of levels back to 5,600. I'm trying to get this back to 55 and make some money. I still have yet to move my buy stops lower, but I'm probably going to. If I start spotting a bottom pattern here, I'm taking this chunk of buy stops, moving them all the way down. I'll lower my cost basis more. Here's my profit window, and I'll still make, probably 3-4.
I've got a similar concept going on with CAD Swiss right now. Kind of a similar trade to Australia. Exactly. Got a commodity currency. I've got 2 positions on, but yeah, I mean, I think you get any sort of any sort of normalization, a lot of the currency market will do what currency markets tend to do, right? To
Yep.
go back and forth over the long term.
Yep.
So I've been accumulating CAD Swiss. Aussie Swiss is on the list too. I wouldn't mind picking up some of that. I think that you play for the rebound there overall. That's at least what I would be doing.
Yep.
And then on the dollar, I have a euro dollar position. I'm looking to scale out or take profits on that one if we get like 112. So I'm playing this, maybe another squeeze higher on the euro. But to your point, I mean, what's going to replace the dollar? I don't know that anything is for now. Like, what do you want? Do you want a world that's run by China? Are you kidding me? Like, is that what we want? I don't know what the alternative is. I mean, clearly an obvious pick for everyone is gold, right? Gold is always that, when in doubt, gold it out, if you will. But the euro maybe getting a little bit of relative strength in all of this. The British pound, I mean, UK struggling with severe stagflation. It's just one of those things. It's like you look at currencies, you look at this global situation. This is not, oh yeah, no, US is going to torch itself and everyone else is going to watch unscathed. No, it's the
whole
same.
world's going down, man.
We talked about
the US
this.
goes down, it's taking the whole world with it. And that's why I'm like, at some point, that narrative has to change because the US obviously doesn't want to fail and the whole world doesn't want to fail. So figure it the fudge out,
Yep, exactly. And again, you talked about this many times on the stream. I listened to you talk about this concept of if the rest of the world goes into a recession, the US will be dragged lower. And now we're seeing the other way around. If the US is going to, light a torch and throw one at everybody and start a big trade war, it's all one system, right? Whether people want to like it or not, or the US wants to deglobalize or not, like this is a global system. The internet made everything connected. So where one part of the world is very hurting, it can hurt the others. Even our biggest rival, we are their biggest customers, right? China, like it's all connected. So I do think that the US dollar could continue to have a little bit of a repricing event to the downside. We may still see some short-term downside for the dollar index, but there does become a point where currencies kick in. And again, they go like this over the long term for the most part. They chop around. And I think that the dollar at some extreme, you can't just say, oh yeah, no, the dollar is going to collapse to zero. And then just in the same breath think like, oh yeah, and no, the euro is going to replace it unscathed. No, the whole world would be on fire if the dollar index, if the dollar completely collapsed.
Yep. Unless you talk to Michael Saylor.
Yeah.
He's got the answer.
Bitcoin.
Which, and I literally had that conversation with one of my best friends on Saturday. And I like that whole conversation. A Bitcoin enthusiast is like, but then there's Bitcoin. It's like, that's still connected. BlackRock, with trillions and trillions under management. BlackRock is still tied to Bitcoin, which is tied to the securitized nature of the entire financial markets. Bitcoin is not immune to the entire world struggling.
And and like one of the biggest holders of Bitcoin is the U.S. government through confiscation of Bitcoin.
Yeah.
Do you know that?
I didn't know that because I thought that was the whole disappointment with like the world or the fund that we were creating was like our strategic reserve in the U.S., but it was just confiscations and fraud or whatever. But I mean,
the Silk
does
Road
the dollar
stuff and all sorts of things.
Do we start to like sell gold to buy Bitcoin? Is that the kind of weird rotation that might happen? That's another case for the gold, 200 EMA to get hit is like, oh, the U.S. is going to sell its gold to put more in Bitcoin. It's like, I still don't love that. And this is a conversation probably for another time. The one thing that makes me a little concerned about Bitcoin is watching, Trump and his family have the talk of a stable coin, having a pump and dump with like the Trump meme coin and the Melania meme coin. It's like, I don't understand how that's even allowable right now as president of the United States. I get there's corruption, but that's like, how much more like in your face could you get if it's like, yeah, my family's making billions of dollars on the side doing pump and dumps and something that's like completely against the entire financial system. So anyway, we'll talk about that later. But
Chris, you mentioned the Bitcoin. Well, you didn't mention it, but you kind of hinted at this concept. I've got on my screen pulled up the Bitcoin to gold ratio here, which we mapped out a little bit of an indicator within the Edge Finder for easy access. But just because, again, I think even though you were saying it in a joking way of like, oh, we're going to sell our gold, buy Bitcoin, it just goes to show this is the market environment that we're in. It's happened countless times in history. People
Yep.
forget about gold. Oh no, gold is boring. It's this rock. It doesn't yield anything. And
Yeah.
then suddenly everybody wants it when the world falls apart. And can that get overdone? Of course it can. We were talking about that earlier. Maybe a little due for on a bigger term picture, a pullback. It's been in a straight up move for some time.
Sure.
But again, I can't help but tease just a little bit the Bitcoin bros who think that when the market collapses, everybody's going to buy Bitcoin. That's such a crazy concept to me.
Well, on a positive note, I will say with Bitcoin bros, I mean, look, I have Bitcoin. I've got client allocation of Bitcoin. I will say that it's the only one I've really cared about. I did some speculation. I had some Solana, some Litecoin, some BAT, some other garbage, but it's like Ethereum and Bitcoin have been my two major focuses. Bitcoin's pretty much my exclusive focus right now. And I'm good with that. Like whatever that is, if it's the S&P of the digital world, so be it. If it's the standard of digital currency, so be it. I think it's exposure. I like the statistics. I mean, Bitcoin was created arguably right after the great financial crisis. So I understand, the scarcity, the reasons. I understand the fiat system is on possibly borrowed time, and that reset is maybe coming faster than what we need than what should be. But because the whole world is interconnected and everyone has debt and everyone has operated and grown with debt. I mean, look at the Eurozone, Nick. The Eurozone has been behind because they don't want to spend any money. Germany always wants to have a balanced budget. What are they doing now? Spending trillions of dollars on defense and growth. It's fiscal policy for the first time in a decade. Right? Because before that, it was Mario Draghi monetary policy, kitchen sink the Eurozone to save it. And it worked out okay, but it was still like at the detriment of Germany handles pretty much everyone's sovereign debt crisis. Like Greece is underwater, Spain, Italy, Portugal, all underwater. But we still have a euro, we still have a Eurozone. But we've had extreme monetary policy, and now fiscal policy for the first time in years has, for a second, gave the Eurozone like this big notch, and it's like, oh, look at Germany. Look at the DAX. It's outperforming the US. Look at it now. It's negative. And just like that, in 3 days, it's gone. It's like, that's why it's so connected. And I know the argument is Bitcoin's different. It's like, it's not. Bitcoin is still connected. Bitcoin's still resilient. But I think possibly now, all the meme coins, all the crap, all the NFTs, all the SPACs, like all that stuff's gone. Like those have been the traders that have been burned. Right? If you're in the pump and dumps, you're probably not, you're holding the bag. If you're in a SPAC, they don't exist anymore because nobody's like IPOs don't even exist right now because nobody wants to come to market right now. So at least Bitcoin is like, well, most people don't sell their Bitcoin, so they're just going to hold it. So I think that's where this built-in resiliency is. Like nobody's dumping Bitcoin because now you have financial advisors that have taken the risk of say, look, based on statistics, if we have 1% allocation of Bitcoin, we could potentially outperform the S&P, by 2 times. Right? Like if you have 99% SPY and 1% IBIT, arguably for the last 10 years, that would be an average like 15-60% return average. Yeah. Which is doubling your S&P performance.
Yeah. If you get the same kind of environment for the next few years, then that's the only,
which I don't believe for a second. 10 years is not a massive.
But even if you get half, of
it, sure.
Still, that's fantastic.
And for me, it's like I've got about a 3% client allocation. I personally have closer to 10. I'm willing to take that. I've got a horizon I'm not really worried about. But a 3% allocation, if I get, like you said, half of that performance, that helps. That helps give me some alpha. That helps give me some edge. That helps give me something statistically that helps me make some money, makes my life a little easier.
Well, and I got to say too, I've been picking on Bitcoin a little bit so far, but if we show my screen for a second, I mean, here the stats don't lie. This shocks me, Chris. To be completely honest with you, if you had told me that the Nasdaq was down 20% from the highs, I would have told you my guess
50, 60, 70.
60.
Yeah.
This is what I've been saying.
Yep.
That would have been my guess. So to the crypto bulls' credit, even though I'm teasing you, 30%, I know that's still painful, but that is not out of the question and out of the normal expected moves for Bitcoin, first of all. Second of all, my normal expected move would be like a triple leveraged ETF of the Nasdaq. That's what I always kind of equate it to.
Sure.
And clearly my thought process on that is not holding up. It's way outperforming my expectations in this type of sell-off.
Yep. And maybe the argument now is it's becoming the S&P. It's the new S&P.
Yes. It's the new global reserve currency. That's for sure.
You never know. You never know.
Who knows, man? Who knows? Yeah. It's crazy times.
All this conversation comes back to exactly that. Nobody knows, right? I wish I had a crystal ball. I don't. The only thing I can do is define my risk, trade smart, don't be greedy, survive, survive, survive. The market, as we know, will give us all the evidence, all the confirmations, all the signs we need to take the trades we'd like to trade and confirm. But man, it's like if it's such a messy environment right now, this is not the time to say I mean, and that's what I'm saying. I want to buy. But if this just goes lower and lower and lower and it has to grind out something like that, like I'll wait. This is good structure. That's the explosive move to the upside. This is, I go back to this like timeless lesson I've just kind of had for all these years, which is I can trade anticipation or I can trade confirmation. I can make a lot more money if I'm right with anticipation, but I also have the stress of the unknown because I'm getting in too early. If I trade confirmation, sure, I don't pick the bottom, I don't pick the top, but it's a lot less stressful when it's like, yep, now it's time to trade. And you
Yeah.
just trade what you see. That is a lot better than guessing where this top and bottom, in this case, bottom for the S&P is going to be and hold. And so I think this is, the market pricing in some bad stuff. This is the shakeout that's going to be really, really messy. And we'll see what the pattern is. But I'm sure there's going to be something tradable in here, Nick, that we can spot. And maybe it's a bear trap that goes back to range highs. Maybe it's a falling wedge. Maybe it's a flush down and then a rip back up here, and then it's a bullish pattern that we can trade on a wave 3 or something. Like we'll figure it out. But it's just having the patience and hedges hopefully help protect. Don't take on more than you can afford to lose. And I think the hard part for any trader right now is if you're in a drawdown with little to no buying power, that's never a good place. I say that because in 2021 rolling into 2022, that was me. I made so much money in 2020 and 2021 that I just kept it rolling. I was like, I'm on a heater for the last 2 years. Like, let's take this into 2022. And I was still selling premium and I was still protecting my positions. But man, I battled all year just to stay at my high watermarks, and currencies were really what saved me. Hedges and currencies saved me in 2022 to still be positive because Q4 was a great quarter. And that's really where I got most of my gains, but it was like battling, not losing. And a lot of options like kind of helped me survive, but it was not a fun year to trade because I didn't have any cash. I was fully invested going into a top in the market. That's never a good thing.
And that's a great lesson there too, because again, our conversations, Chris, helped me tremendously with that because again, you and I discussed over and over the importance of having some dry powder, the importance of spreading things out. We've talked about that till we're blue in the face on this live stream to our audience every single time we discuss. We talk about having, how much cash are you sitting on, how, always having that conversation at the highs, you and I both being like, okay, this is a point where you sit back, you let good things run, but you be careful adding. And then that makes a world of a difference in this environment, Chris. I'm sleeping just fine at night because I have dry powder and I'm working in this. I feel when you have dry powder, look, if you're fully invested, in my opinion, if you're fully invested, meaning all your margin or all of your cash in your portfolio is dedicated to something, my personal opinion is like, okay, fine, but like you better not be looking at the markets every day and you should probably just be passively invested.
Right.
Because the only time you should be fully invested for my style of trading and investing would be you get a huge market correction and signs of a bottom forming. Maybe I'm looking to start get full. I'll take that risk because I think that's when timing wise, it's worth that risk. But if you're cash heavy or building cash or have something to work with in this environment, you feel smart where you've been feeling stupid for some time. So last year we talked about, market just rips to a new high, gave us like no chances. There was like little to no chances for pullbacks last year outside of this one time the S&P 500 went down, just barely tapped a 10% down move. So there was little to no thing. And so during that time, it was frustrating. There was many times where market just ripped on without you. And if you weren't fully invested, you felt dumb for not being fully invested. And then we're getting vindicated right now, right? We're getting reminded why staying nimble, staying low, position sizing, more high cash or building cash. We're getting vindicated for that right now because we can actually put that stuff to work. We can look for setups. We have powder to work with. And that is the important lesson there, because again, this period, if you're just fully invested, and I know there's a lot of people, I'm not picking on you if this is you, but this is something you can learn from. Chris just talked about his experience being fully invested at a high and how painful that can be when you feel stuck. You can't do anything. You don't have anything to take advantage of opportunities. It's a really painful lesson. So just something to think about. You're either feeling like you have the chance to build here and work, or you're feeling stuck. And those are two very frustrating feelings, or amazing feelings, depending on which one you're in.
Yeah, it's never fun to feel stuck because you're essentially paralyzed. And
Yeah.
when you don't have the capital to do it, I mean, I think I've done it once in my entire career, which was put more money into my account to cover, or at least have some buying power back.
Yeah.
I've done that once in 25 years. So, I'd say I'd be fortunate that I've had some early lessons that were pretty harsh, like over leveraging in currencies where I saw a margin put like a margin call.
Mm-hmm.
Not because I was in necessarily a big drawdown, but I just quickly over leveraged, and I
Mm-hmm.
went to 7 standard lots when I had a $25,000 account. This is like back in like 07, 06, 07.
Mm-hmm. Yep.
And going to that 7th standard lot, which I thought was a great trade. I was only down 10 pips, Nick, but
Yeah.
I margin called and I had drawdowns of other positions, and I lost like 3 grand just like that from my broker. So,
Mm,
yeah, that was the first lesson of like, oh, that's what over leveraging feels like. And then
yeah.
from that point forward, I never did it again. And
Yeah.
it could have been a lot costlier. It could have been way worse. But this is what we've said. It's like the market will teach you whether you like it or not. The market will teach you.
Absolutely.
Obviously, I think people learn a lot more lessons from pain and loss, and that's unfortunate. But that's life too. It's like you learn a lot more by being emotionally tied to things. And when people are fearful and people are scared and people don't know what the hell's going on, you're going to learn a lot more because you're emotionally invested in all of this. So, you handle that, you manage that, then you survive it. But I think that's why I've tried. I mean, my personality is definitely more pretty even keeled. It takes a lot to get me like, I mean, I get frustrated, man. Like this last couple weeks has been a challenge,
Yeah.
especially because I'm thinking it's not just what I'm trading. I'm not really worried about the mechanics of my trading. It's more like, what is the bigger picture here? What is the chessboard look like right now? And I can't figure that stuff out. I mean, I have no control over that. So all I can do is trade and control what I can control. But man, it's just frustrating to think, like, I don't want to be surprised by the black swan, right? Like if like, how bad does it get? That's why I'm saying, dude, this S&P could go down to 3,000, be a 50% pullback, and I would be okay. I'd say I wouldn't be surprised if it happens. I wouldn't be surprised, as
Mm,
opposed to like, there's no way it goes any further down. I think that's a fool's game right there. If you're
I
thinking like
agree.
it can't go down, it's like it
I
totally
agree.
can. And the VIX can go to 100, and gold can go to infinity, and Bitcoin can go to, like, everything can change, and everything we're doing, we think it makes sense, and there's all this history, and there's all these things that rhyme, but none of it has to actually happen.
Yeah.
There's always
The
the
future is
outliers.
the future is unknown. And
Yep.
that's the thing is control, or focus on what you can control, not on what you can't. That is the path to survivability. So when you hear
Yep.
people say, "Oh, it has to bounce here," or it can't go lower, or it's going to crash for sure. Like any of these absolutes, to everybody listening, if you hear
Yep.
anybody in comment section, YouTube, people speaking in absolutes, ignore it, because it's a dangerous way of thinking. If
Yep.
you are somebody who thinks the Nasdaq can't go down further, it's already gave up all these gains, or you're somebody who thinks that the market has to crash from here, both of those are equally stupid opinions, in my opinion, because you don't know. You don't know. What can you control? You can control your position sizing. You can make educated guesses on what you think the market will do. But we say it all the time on the show, hold strong opinions loosely, right? Loosely means your position sizing isn't going to kill you if you're wrong. And if more people just took that lesson right there to heart, there'd be a lot less people who are in agony right now, because they're super leveraged tech stocks, or they bought with all their heart, soul, and mind. They bought puts at the lows, and now one little bounce back and their puts are worthless. And again, you have to be careful out there. Playing defense is the way to survive.
Yep. And as I think it was an old NBA quote, I think it was Magic Johnson: "Defense wins championships."
Mm-hmm.
The actually surprisingly, well, I guess in the NC2A, it was not the best defense that won, because Houston made a terrible play at the end of the game for Monday's game. Um, anyway, whatever. I was making a great sports analogy, which is defense wins championships.
Yeah.
In football, what happened this year in the Super Bowl? Best defense in the league won, right? Like the Chiefs looked like crap. the Eagles pounced on them, and it was best defense in the league. So take the trading. I think playing defense, look, it's boring, right? Nobody likes it. It's not fun to play defense. It's not fun to hedge. It's not fun to give back money when it's like, this Chris guy talks about hedging, quarter of his account, quarter percent of his account. Right. But it also saves me when we do have inevitable bottoms that rally back up. Those little 1/4% risks that pay me 2 to 3 to 5% gains helps me battle through drawdowns, helps me battle through dips in the market. And I don't want to be bearish. Like I'm still not tilting my portfolio bearish, but I'm still hedging just in case. And those hedges are insanely asymmetric right now, which could be very helpful, or it could just as well be like a sacrifice if the market finds its footing again and starts to make this rip. But I said this earlier, Nick, if you caught this on my solo stream, and that was, I don't like that we have people like Besant, Trump, Navarro saying the market's going to rip. Be patient. I'm like, don't say that, dude.
Yeah.
Right? Because like all that means to me is like you're going to flush everybody out first before the market finds its footing. And, by the time the market you can celebrate, oh, it ripped. It's like, I don't think it's this year. Like I think I would be shocked. We have to have like an amazing deal come together with the whole world, in my opinion, to see all-time highs again this year.
Yeah. I mean, all-time highs. I've heard a lot of people. I would agree. So, Chris, this is just to go to show some honesty and some humility about the markets, where I don't think there's a lot of this. You and I, we are not afraid to talk about when we're right or wrong. We talked about targets going into this year. This goes to show how much this was my target. My target was 6,600 for the S&P 500. And I mean, now it's looking like we'd be, as you just said, we'd be shockingly lucky to see a market that is break even for the year, because that would result, or that would be the result of, from the lows, a 30% up move, or 27 whatever percent move higher. I think that's pretty unlikely. So are we going to have a V-shaped recovery? Well, I have to talk to you about this, Chris, before we move on, and we got to kick you out of here because we got our next show host taking over. But last thing I want to talk about here with just a second is V-shaped recoveries have almost always, at least in my experience in studying the markets, been the result of the Fed stepping in.
Yep.
And that's something we've got to just think about here for a second. The Fed, at least now, maybe they're trying to talk a big game, but they don't seem adamantly wanting to step in and cut interest rates aggressively because they're still struggling with inflation. It would be shocking if we did get a V-shaped recovery. But the two things that I think you'd have to get us a shockingly sharp bounce back like that would be the two puts that people are talking about would have to reverse. Everybody is now saying, oh, there might not be a Fed put and there might not be a Trump put. I think the only way you get a V-shaped recovery is both of those things turn back the other way, and we do get a Fed put and we do get the Trump put. So Trump steps back, negotiates and has progress with these other countries. And at the same time, I think you need the Fed to cut rates a couple times this year. You have to have both of those situations. Maybe another Fed put wild card could be QE in the form of adding to their budget. But I'm not saying I think these things are happening. I'm saying that's why I think it's pretty unlikely that you get a huge V-shaped move, is you have to have both of those things come in tandem, I think.
Yeah. And also the Fed has been more like surprisingly vocal about the tariffs linked to inflation. So, I mean, if that's a concern, I really think if the Fed is smart, and I think that I really think they are. Everyone, hates on the Fed because they're always reactive, which they are. They're always reactive. But unless the bond market breaks, Nick, they're not coming to the rescue. The stock market at 21%, they have been zip, like no real emergency, anything. I mean, I saw the silver handle Trump endorsed account that said, oil's down, treasury's down, which is bullshit right now. Fed should be cutting rates. Like, you can't strong arm the Fed when they have the agenda of its price stability, which we have seen less of that lately. Employment, which is fine for now, but tariffs, inflation, like that's the sticky event that I'm watching Trueflation. I think we're going lower. The CPI that comes out tomorrow, PPI on Friday, I would think that the improvements will be there. But I don't know if it's going to be like this dramatic print better than forecast. It might be right at forecast. Like the headline CPI is forecasted for 2.5. I think it was previous 2.8, forecasted 2.5. If it comes in 2.5, I mean, that's probably good. That's a pretty big improvement. Again, they could shoot themselves in the foot by having a forecast of 2.5 and it comes in 2.7. You're just like, well, it's better than previous, but it's higher than forecasted. You
Yeah.
know, so I'm curious like what the numbers are, but that could be enough to be like, well, inflation is coming down again. Does this make the Fed cut sooner? Probably not. Like right now, it's telegraphed to be June, July, October, and maybe a December. Like there's or maybe it's a September, October, something where it's like there's four cuts planned based on the probabilities right now in the CME watch tool. It could all change. I don't see, I mean, same thing with September. That emergency cut in September for 50 basis points. If we did the same thing in May, where it's like, well, it's not supposed to be a cut in May, but if they did indeed do a cut and they did it at 25 or 50 basis points, I think the yield market does the exact same crap it did last September, which is go the opposite way.
Mm.
So
Chris,
I
they're
don't think it's going to get
forecasting
any better.
2.5% for CPI year over year. It's very
What's that?
interesting. I'm
2
seeing
point,
on Forex Factory, it's a 2.5%
yeah,
forecast.
previous was 2.8, forecasted
Yeah.
2.5 for tomorrow's print. And that's
Yeah.
the headline CPI. The core is still higher. The core was like 3.1
Yeah.
forecasted for 3%. So
You
that's
got
still
oil prices coming down, some concerns about, layoffs and that sort of thing. So
yeah.
who knows? Maybe we do see. But again, I think, if you really want to get people to get excited about Fed rate cuts
Yeah.
that are not, for the purpose of labor statistics materially weakening, I think you really need to see get close to that 2%. If you said, okay, we're going to trend pretty quick down to 2% and stay there, that gives the Fed some ammunition to work with. But again, if tariffs are an inflation bump, which we're yet to see how that all plays out, we'll have to see, man. It's a world of unknowns. That's why markets are so volatile. I mean,
For sure.
this stock market, Chris, I can't recall, not since COVID, a time where you would see swings in the market, 7.6% swing in the day, 7% in a day. Today, which feels quiet somehow, still a 4% swing in the day. I mean, this is just off the charts volatility.
Yeah, it is. And I think that's was also, I mean, looking to be more like there's clearly something there. There's clearly something at that low that matters right now. There's at least a brief line of defense, but there's not enough to justify it going higher. Like not yet. So I just don't see the price evidence to say that the bulls are really back in control. Remember the market is forward thinking, and the market was clearly forward thinking with kind of a worst case scenario with the tariff war, the trade war, tariff tantrum. So that was our quick 20+% drop with that 12% coming in 3-4 days. But if the market was forward thinking, now thinking, okay, well, the Fed is looking to cut rates because inflation data is improving. It's going to be an interesting tilt to the market if we stabilize at that 20% correction in the S&P, and then the Fed is, I mean, minutes are minutes. Like it's just going to be a statement, right? Like there's no Jerome Powell anything today. But between FOMC minutes today and inflation data, is the market going to be positioned enough to say, hey, look, I think the Fed is doing this. But again, my concern is the Fed cuts into a weaker economy. That's never a good thing, right? Usually the market's dropping, the Fed's cutting. That's usually like signs of things are getting worse, but the Fed's not, I just think the Fed is not coming to the rescue as far as we're going from, what are we right now, Nick? 4.25? Is that our interest rate? 4.25, I think 4.25, 4.5.
I think it's 4.5. Yeah.
So we're looking to cut another 100 basis points. Okay. But the emergency would be if the Fed's coming to the rescue, we're cutting to 0. Okay. Well, how nasty does that look? Look, we got out of 2008's great financial crisis with $700 billion. We got out of COVID with $6 trillion. What is 2025 going to be? If we had to have an emergency lever for the Fed, Nick, it's going to be like 10, 12, $15 trillion. I mean, that is the fiat system blowing up, because that's all you can do is dump more funny money at it. And it's just not sustainable. It's already not sustainable and everybody knows it, but the can keeps getting kicked down the road. But that's my concern, is how much bigger does it have to get to bail out? And if the Fed cuts too soon and the market doesn't react to it, that gets even worse too, because now it doesn't look like the Fed is effective anymore. So it's I think Powell knows this. I think the whole Fed knows this. So it's we can't rush into this too quickly, because if we start being accommodative and trying to, navigate this Fed put now, and the market's going to dump another 5, 10, 15, 20%, the Fed's cooked. They can't go emergency measures and then watch the market go against them. It's they want to do it when all the pain is in. And I'm curious, with that S&P above the 50-day and the Nasdaq above the 50-day, that's the lowest reading I've seen since a bear market in 2022. I do wonder, it's like, I mean, I think the market's been beat up enough, but I don't think the retail side has felt the pain yet. I do have a question on Edgefinder. Do you have a crossover chart between like retail investors and institutional as far as money flow?
We have, let me see if I can show you this. We have institutional positioning, this smart money indicator.
Okay.
It's kind of fun. It takes a look at, let me see, Nasdaq, for example. COT net positioning in blue.
Yep.
And then this is basically a derived score from the put to call ratio.
Okay.
So put to call ratio, basically showing retail super bearish right now, at least according to the options flow.
Right.
And net positioning for COT, I always like to look at it in isolation personally, just a little bit closer.
Mm-hmm.
The only tricky thing with COT data you have to be real careful with is, especially right now, Chris, a lot of people are looking at it, they're like, oh, they bought. Well, yes, but this is last Tuesday's data.
I was gonna say, it's
A
always on
lot has
Tuesdays.
happened.
Yep.
Yeah, a lot has happened since then.
Right.
So we'll get some fresh data on Friday. Maybe that will be interesting. The thing I've been looking at the most has just been staying true to the put to call. Look at this thing.
Yeah.
But again, to your point, I thought the put to call ratio was high over here and over here. And then boom, it just really took off, you know?
Yep.
So crazy.
Okay. Yeah, that's one kind of the charts I'll be looking for. I'm going to try to find like if I can see that institutional levels are coming back in, like as far as like, and I can follow money flow. That's one indicator I can always use. I think it's CMF on TradingView. But if I go CMF and I'm seeing that institutions are, you know, elevated while the retail crowd is dumping, that to me is showing that like real smart money, real big money is actually willing to step back in. That crossover to me is a pretty good sign that you know, real money's come back into the market for a sustainable investment, as opposed to like short-term, you know, net swings. And retail traders are typically always over leveraged and they're gonna get beat up the worst.
Here's one that I found really interesting, Chris. This is the historical data for the Japanese yen. Look at the yellow. The yellow is showing you the long percentage overall for contracts traded on the Japanese yen, institutional money. Look at how steadily before all this took place, there was just a buildup in bullishness for the Japanese yen. I find that just so interesting. We also saw that back in August, right as that kind of big yen strength came into the picture, institutional money was building up, and then they deleveraged on that yen, and then now getting back into Japanese yen for the last few months, and which has been a great play here recently. You mentioned FXY, you're playing that. I mean, yen's been very strong recently.
Yeah, and it's been strong. I just haven't traded it with FX because I hate the negative swap. And
I don't blame you.
So 6J has been better. FXY has been better. And I'll hold though. Like FXY has been a good hedge. I'm not up a ton of money. I'm up like maybe $6,000 or $7,000 ish on FXY for all my positions.
Yeah.
Not even. I'm up $4,000. So yeah, nothing fancy. But I didn't take a huge position. It was 6J was fine. I made like 100% return on my 6J position within like a month or two. That was a futures play. But I didn't want to wait until September. I was a little miffed at the futures market for only having contracts up to September. And so I'm like, if I could, I'm going out longer term. So FXY longer term has been fine. I just own the shares. I've done diagonal spreads, taken some pieces there. So, but in the currency market, I don't know why I hate the yen so much. I just do. I think it's because I'll say why. Technically, I love efficiencies. I love like the pureness of the Forex market. Put all out the window when you trade the yen. Like the yen is technically obedient, like on a massive pattern scale. You find a great pattern and it's probably going to be fulfilling. But when it runs, everyone wants to like buy a dip. It doesn't happen. You just get bull flags. When it crashes, you want to sell a pullback. It doesn't happen. You just get bear flags. Like you have to basically, I've made more money trading buy stops on the way up or sell stops on the way down because the yen just runs that far and that fast.
It's very different currency than most of the other ones. Very different because, you know, even going back, man, like 5 to 8 years ago when I was doing tons of back testing and stuff, it was like any strategy that I would test that was more focused on like a mean reversion, like dollar cost averaging back and forth, was very hard to get right on the Japanese yen because of what you're talking about. You get these trendy one directional moves where this move to the downside, there was no pullback. There's no pullback, just a straight down, and
Pause.
then straight up move. Just
Yep.
very frustrating to try and trade anything back and forth on yen pairs.
Yep.
And
So
maybe long term, maybe like, and that's the other tricky thing with the yen is for many traders, unless you have a very large account, yen movements are pretty big, even on minimum lot size positions. Like if you're stacking 0.01 lots, it could still get pretty ugly with the amount of volatility that yen pairs, move. Just the
dude,
craziness
I can
there.
tell you exactly how ugly it gets. I was trading micro lots and losing thousands of pips at a time
Yeah.
in that fight in 2022. So, yeah, it can still go way more against you than you thought. I mean, look, dude, we went from 120 to
Mhm.
152
Crazy.
in about 7 months. It's like it was
I
a
remember that.
yeah. I mean, I remember it too, and it was and like I said, you don't forget it when it's emotionally there. And I was like, I was so mad at myself for taking like what was a good technical trade.
Mhm.
And I mean, the discipline was like I dumped positions every 1,000 pips. I took losses, and I just took, from 120, 130 took a loss, 130, 140 took a loss, 140, 150 took a loss.
Mhm.
Everyone could see, and it's like, why don't you just go long? Well, I was long Aussie yen, euro yen, pound yen. Those were fine. Those were kind of my hedges against my dollar yen. Eventually, the dollar yen, I got my money back because I did have the short from that 152 high all the way down to like 130.
Yep.
And that was also dollar cost averaging, stacking in positions, adding to those sell stops on the way down. So I had about a 5% drop on the way up and about an 8 to 9% swing on the way down. I netted positive. It was fine, but it was like, dude, that was a 7 or 8 month battle for me.
You want to hear,
And it was
my
I was
battle
shooting
real
for it.
quick, Chris? I'll
Yeah.
tell you my battle. I don't know if I've told you this before. I think I might have told you once, but my battle was with the euro Australian dollar. This pair kicked my butt in
Mm.
2020 because
Oh gosh,
I
dude,
was
2020, yeah.
I was trading this thing and did very well for a very long time.
Yep,
This is how all these stories start, right?
yep.
You do really well selling rips, buying dips, selling dips, buying. I made a lot of money trading the euro against the Australian dollar. I got to know this currency pair very well, or so I thought. And this is
Uh-huh.
why volatility matters, is because all of a sudden 2020, which I wouldn't go too hard on myself or anybody else who had a hard time in 2020 because it was one of the most violent VIX movements in history.
Yep.
You had just insanity. So it also reflected in the currency market. And I was trading 0.05 lots. And again, I wasn't making, I figured I was being pretty decently responsible with my size. I think I had, I can't remember the trading account size, but on my trading account, this was not a huge, it was actually a small position, but I was stacking them and I was dollar cost averaging. And this thing just absolutely just ripped in one direction
Oh
like
yeah.
no other, straight up for
That's 2,000 pips, dude.
yeah, just weeks on end. Now I survived this, but like yourself, this was a battle. And I'm not going to lie to anybody here, when this move happened, this was a Sunday night. I was sitting with my family out. We were doing a cookout, and I opened up my phone on that Sunday. Shouldn't have opened it up. The Sunday night open, Forex Euro Aussie just went straight up.
Yep.
And
Nearly 1,000 pips. Flash crash.
even yeah, even though I was being as disciplined as I could, dollar cost averaging slowly from the beginning,
Uh-huh.
just goes to show, even when you think you're being risk adverse, the markets can still shock you. I came out
Absolutely.
okay. I ended up actually making small amounts of money, closed out of that trade, and just walked away feeling so thankful that I didn't get smoked further than that. But just goes to show the currency market is no joke.
Yep.
Nothing in trading is easy.
For sure. Yep. I have probably 5 of those stories.
Yeah.
New
Yeah, I've got
Zealand
plenty
dollar,
too.
Swiss
Yeah.
yen, dollar yen,
That was just
pound
the most
Aussie.
sinking feeling for me ever. I
Yeah,
was like,
no,
I felt like I
I
did
was there.
everything right here, and
Yep.
still the market kicked my butt.
Yep. Well, I mean, in that move too, I mean, you're talking over almost 4,000 pips, dude. That
Yep.
flash crash move almost hit 2.0. The bottom there is around 1.6. That's a
Mhm.
4,000 pip move in what, a
Mhm.
month? A
Yep.
month? Yeah. It's like currencies don't usually do that. Which is why I try to stick to the boring ones that don't have crazy volatility like that. Like I'm a boring currency trader.
Me too.
Aussie CAD, New Zealand CAD, Swiss pairs are fine. I know they're being
Euro
sold right
pound,
now. Euro pound super boring. 30 pips a day
super
maybe.
boring.
Love it.
Love it.
Love it for that exact reason. Yeah.
Yeah.
Yep. Despite the
Yep.
margin being higher than that. Once we had 2016, the margin did jump on that, but
That's a
it
good
pays
point.
like a for the euro dollar because they're both higher than the dollar as far as their exchange rate. It pays like $1.20, $1.30 for a pip. Um,
Yep.
but still, I mean, a 30 pip, it's like you can you can kind of sit in the euro pound as long as you want to, trading small and survive pretty much anything. So
Look at
that's
Euro
not
Aussie, Chris. I didn't even recognize this, but it's
I
doing
know.
not nearly as sharp, but that's actually interesting how it's
I
kind of
know.
making a similar.
Yeah, look, Euro Aussie, Euro CAD, Euro New Zealand, they have all been like this. And I just, it's my word of warning. It's like when you get risk off trades like this, they are so
Yeah.
strong and so one dimensional. If you, and that's the hard part is Forex is so pure that you can sell resistance and buy support. But when they blow through these levels with irrational moves, look, at some point, this probably results in a flash crash and it'll come back. It'll like that pocket I see at 7,400 will probably get hit, but it's
Yeah.
not without the pain of does it go up another 200 to 800 pips before it
Yes.
tops out? I don't know. And I'm just
It's
not going
almost
to take
like
that.
when currencies go into this mode, it's almost like a GameStop situation. It's
Yeah.
insane because you're talking about the entire economies of two huge parts of the world, but the price action feels very similar. Like GameStop, we all looked at that. People with experience looked at that and said, we know how this story 99% of the time ends, but you don't know when it ends, right? So GameStop went up like straight shot to the moon. And then I thought, oh, this is going to end ugly. Well, it did, but before it did, it straight up for another 100% or whatever it was.
Yeah.
So just goes to show you have to be so
Yeah.
careful thinking markets can't go further than they can.
Look, the markets will always surprise you. It might be few and far between, but the markets can do things you never thought were possible. And that's why I probably spend a lot of time racking my brain on what would be the worst case scenario? What would be this most extreme move, which hopefully I'm just not tied to the tracks as it's happening, but trying to play that type of outlook where I wouldn't be terribly surprised to see the market drop 50% this year. And if it does, I'm kind of prepared for it.
Mm-hmm.
It doesn't mean I'm bearish to it, but it's like I just want to know that am I bulletproofed and battleproofed for the market to do something really silly like that. So, like I said, I think the best way to make money is to do it consistently. And that's just my opinion. I know that some people might disagree and be like, well, I made so much money and I'm way better off for it. It's like, right. But if you made a lot of money with bad habits or something that was really risky, those usually don't pay time and time again. Like I've been a long-term survivor in these markets and it hasn't been the most glamorous way of making money, but I'm still here trading, 25 years later. And that does help as opposed to, man, I wish I went all on Palantir last year. Man, Nick, I could have made a fortune. Right. But if that's how I did it, you're going to be humbled when the market gives you a 50% pullback and you're still all in on that stock or that
Yep.
whatever it is. So I don't know, man. There's so much opportunity. Just take it and appreciate it. Use defined risk. I like to survive in the less than 1% risk area because I can take thousands of trades without ever really damaging myself too badly. I can obviously catch wind of a momentum trade. I can be a little bit more aggressive when I like things. I can stack and tilt my portfolio certain ways. There's all sorts of ways to do it. I'm not saying my way is right. I just know that for me, it works. I'm pretty comfortable. I do sleep fine at night outside of everything else. Having a 3-month-old kid, which fortunately my fiance gives me plenty of time to sleep for my 6-hour blocks at night. But yeah, anyway, survive and move on. So anyway, hey, do we need to wrap up here? I was just curious. I mean, I've been going for a while. I
We'll get you out
appreciate
of
the time.
here.
It's been a fun segment.
Yeah, for sure. Chris,
okay.
we'll see you tomorrow. It was good having a conversation with you here.
For sure.
And real quick, guys, we're going to take a quick break, let Chris go, and we'll be right back after this. See you later, Chris.
All right. Thanks. See you guys tomorrow.
If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show. All right, we're back. Good conversation with Chris, as always. I just ran and got water, so if I'm out of breath, give me a second. So, what charts you guys want to look at? We have some chart requests. Anybody in the audience? questions, chart requests. Take a look at the chat, see if I can answer anything for you. Getting that cardio in. Yeah, seriously. Life of a trader. A lot of time at the desk. Okay. Gold, silver, bonds. Yeah, let's look at gold for a second. So I'm not going to lie. Gold today, I'm feeling very, very... So here's where I'm at. Let me give you guys a little bit of a personal portfolio update. And maybe this conversation that I'm about to have with you will hopefully help you to also think about your own trading journey. At the end of the day, I think my goal with my channel is to share my authentic journey in trading, mostly because I think from a content creator's perspective for you guys, me sharing with you my P&L, my ups and downs, what I'm going through, I think that people see themselves in these conversations and it helps them to reflect. I think honestly that is one of the biggest values to what my channel is about, because all I can be on my channel is I could be myself. I could tell you what I'm doing, why I'm doing it, how I'm doing it, all that good stuff. So I'll give you a portfolio update on how things are going. Let me see if I can just pull this up. Okay, where are we at? So here's year to date how things are going. So I'm down in the portfolio 5%, which is upwards of $50,000, which is, that's a lot of money. But I'm working on a larger capital basis. I've been doing this for many years. So, this is the result that I'm working with. Multiple years I've done very well, but this year has been challenging, just like for everybody. For most people who are investing or trading in the stock market like myself, it's been a challenging year. But that being said, I'm feeling very okay with where I'm at. The S&P 500 is down almost 15%. I'm down about 5%. I'll take that all day long, right? Because that outperformance, if I wasn't invested in, or if I wasn't trading, I would be invested in the SPY, right? That's probably so that's my alternative, my way of thinking here. So this gold trading that I've been doing, right? I haven't played it perfectly. I took a loss on gold here recently and took a re-entry that actually ended up being the much better play. This trading on gold has actually helped me dramatically to outperform by almost 10% on the index this year. Like, I'll take that all day long. It's all relative. Am I giving back some gains like everybody else this year? Yes. But there are many people who are down 20, who are down 25, who are down 50% in their portfolios this year, right? So if I'm down 5, I will take that all day long. Am I happy that I'm down 5%? No. I think it's been a tough year for a lot of people. So I will take 5%. And how did I do that, right? Sounds silly. How did I lose 5% of my portfolio? Well, the reason that I only lost 5% in a horrible market sell-off has been through active trading, stopping out when I'm wrong, and sticking to my system. Now, by the way, just a heads up, the trading that I've done this year has been remarkable, right? For me so far, I'm having a wonderful trading year. Now on the investing side, right, on the portfolio side, stocks that I've been buying have been tanking. Now they're long-term investments, so I'm really not too worried about that. But the portfolio is down 5%, not because of the trading activity is what's saving my portfolio right now. Right? Instead of being down 20, the portfolio is down 5 due to gold trades, due to some of the active positions. And by the way, even though the Nasdaq trade that I took, even though I was very early and wrong with this idea, I stopped out here. I stopped out here rather than taking this whole leg lower. So trading has really helped me to not excel and make a ton of money during this year so far, but to stay afloat. Again, we talked about this earlier with Chris. This is a year so far of survival. People who can survive and who can stay, in the game long term can do okay. But people who are blowing up right now, they're toast. Like that. A lot of people lose a lot of money really quickly in this, and they give up and they walk away. That's where you have to be careful. Nick, you're the only trader that I would be comfortable giving you. See, that's the thing. I don't do any of that. No, I don't do any account management. I don't do any financial advice on my channel. I share what I'm doing in the markets, why I'm doing it, for better or for worse. If you watch my videos, there are times where I'm right. There are times when I'm wrong. At the end of the day, many of my ideas this year have been wrong, but I've still held it down okay because I'm managing my risk when I'm wrong, and I'm trying to maximize when things are right. So gold right now, on a trading perspective, I want to focus more on things that are working well. So gold is my number one most convicted play at this moment. It is my biggest position in my portfolio by far. Gold longs are where I'm at. Why did I get long gold? Was it some magic crystal ball call out from the Edge Finder? No. The Edge Finder leans bullish at this time. Seasonally, it's a decent time to be long gold on a historical 10-year basis. Retail positioning is actually bearish on gold at this time. People are trying to bet the tops in. Meanwhile, PMI data has come out pretty weak for the United States. Retail sales came in weak. Interest rates are falling overall on a trend basis recently. And unemployment rate ticked higher. These are some of the bullish reasons for gold. There's also some other kind of headline things, like, for example, China and the US getting into a trade war. That's a lot of uncertainty, and that uncertainty helps gold to thrive. So gold is a great, in my opinion, place to be long. You guys, I'm not telling you what to do, but for me, in my opinion, my trading approach, I have Edge Finder confirmation. I have a technical uptrend that I really like. We had a pullback to structure, and this right here is a textbook example of my trading style and my approach to using a combination of fundamentals, technicals, and sentiment analysis in the markets. It all kind of came to a fork in the road here. 61.8% retracement held beautifully from the low to the high, got our 61.8%, the quote unquote golden ratio, right? Put a stop loss below structure, and I've got a really nice winner running here on gold. And like I said, it is my biggest position right now. So I'm feeling very good about this trade. So what do I do next? Well, what I'm looking for is a return back to the all-time highs. And if we get a break above, I'm going to look to take my stop loss and move it into profit below any sort of higher lows that could have formed in this market. So that's my game plan with gold. That's how I'm going to be playing this for the time being. And I like this trade quite a bit. Again, staying systematic is the name of the game for me this year. In all this craziness, in all this noise, in all this fear and headlines that are terrifying to read, in all of this craziness, I am staying focused on my system, which is the Edge Finder, aka focusing on economic data, technical readings, sentiment. Day in, day out, same old game. New market, new craziness, new stories, new headlines, same strategy, same game. Staying true to what has worked for me over the years, even in these crazy times. By the way, if you do not have a copy of the Edge Finder, this is a really good time to pick it up for two main reasons. Number one, it's a crazy time where people are just finding themselves spending all day long reading headline articles and watching the news, and social media is terrifying them. Ignore all that and focus on the Edge Finder. Because again, the Edge Finder is not a magic holy grail system. It's just helping us to screen the data and just look objectively at what's happening with services PMIs and inflation data and economic data that just matters a whole lot more than just the scary headlines. Don't trade based off headlines. I'm telling you, it's a dangerous way to approach the markets. The second main reason is because the Edge Finder right now is celebrating 3 years since we launched the product. And for that 3-year anniversary, we're doing our biggest sale event of the year. You can currently get the Edge Finder 45% off during this live stream. So here's how you can get access if you are interested. If you're not trading with the Edge Finder already and would like to pick up a copy, the link that's just been dropped in the chat, click this link to send us a direct message and ask about the sale details. And someone from our support team will give you that information so that you can consider taking advantage of the discount while that lasts. Like I said, it's our biggest discount that we do all year long. It's a one-time payment to get access, and you can start trading with the data and have some clarity to what you're doing instead of chasing headlines and watching price action, which is whipsawing in both directions right now. Focus on the data. That to me has been a game changer this year and something that I plan on sticking almost religiously to this year. Belind, good to see you, my friend. Says the other day he said middle ground for gold. I think this is very important, a safe area for everyone in every sense. Yeah, I mean, that's the thing is right now there's this uncertainty about, is the dollar a safe place to be? Do I want to be in bonds? Do I want to be in U.S. stocks? The only super long-term, quote unquote, sustainable through the ages safe haven is gold. And gold is really attractive for that timeless reasoning right now. It doesn't mean that gold can't have a downswing in the next 24 hours or could even go down for the next week or two. I just think that in this environment, the risk to reward still looks good for gold. Obviously, if you were in the VIP Discord room where I called out this trade, I think this was the time, obviously, to get into the trade. That's why I took the trade. I think that up here, you are you're running the risk of chasing this idea. But maybe we'll see some pullbacks. Maybe we won't. Maybe we just shoot right through those highs. We have a really solid candle here today. That is the most bullish candle that we have seen in months, despite this thing being in a very strong upward trend. This is the biggest green day we've had in months. Actually, maybe in over a year. This is a huge up day for gold. I can't see a candle that's bigger than that. It's crazy. Is gold going to do $100 range today? Oh, it already has. $118 added to the price of gold per ounce. That's insane. I remember the day like it was yesterday when you said in a live broadcast, I'm finally presenting you a project I've been working on for a long time. Its name is the Edge Finder. 3 years, Blunt. That's crazy. Yeah, we launched the tool in 2022. It looked a lot uglier than it does today. It's come a long way. Thanks to the awesome team behind the scenes that, we put in a lot of work on this thing, and we're going to keep doing so. This tool is only going to get better. Look at this, by the way, guys. Put to call ratio for gold, also still very elevated. I find that really interesting. People still buying puts on gold. Silver, I still like, but don't have a bullish reading on with the Edge Finder. So probably not a trade for me at this time. Also, the nasty sell-off that we saw in in silver, the relative strength of gold during that same sell-off to me still makes gold very attractive. Like, look at the relative strength here. Silver got crushed. 16%? Holy, my goodness. Gold, however, held up just fine. Drawdown of a peak of 6.5%. Why is Ethereum low against other cryptos like Bitcoin? I can't really tell you because I'm not a big crypto person, but from my limited understanding is its use case has been outshined in some ways by other exchanges or current coins like Solana and things like that. I guess its use case is not as unique as it once was in the eyes of crypto bros. but I really don't know. To me, I only really pay attention to Bitcoin, which has bounced back nicely today, up almost 2%. What do you think FOMC will do to gold? Depends what they have to say. I think they're going to kind of continue to be in wait and see mode with all the tariffs. They don't have hard data on it just yet. But to be honest, I don't know if we're going to make it to FOMC. Do we have anybody else lined up today? Because I think I'm starting to fade here in terms of live stream airtime today. I don't know if I'm going to make it. Yeah. Here's what I'll do, guys. I think we may be ending stream. We were supposed to have another guest come on the show. Unfortunately, we didn't hear from Kenzo. So I may be shutting down the stream for now. And what we could do in the meantime is I'd encourage everybody here to join our Telegram channel. And I'll make an updated post there about my thoughts on FOMC meeting minutes in case anything is crazy. But yeah, we've had a pretty continuous live stream, and I was on a podcast this morning and I filmed a video. So I think I'm gonna conch out here and take a break from being on camera. That being said, make sure to join our Telegram channel. That's where we'll keep you guys updated with what we're seeing with FOMC meeting minutes. But unfortunately, we're gonna have to bail. That is my bad here. I just don't think I can go for another hour at this time. These things are exhausting, as you can imagine. It's like kind of like presenting for multiple hours straight. It does. I don't know how Chris can do it for much longer than I can. But also I've been on camera since like 8 a.m. today. So I'm gonna wimp out. Thank you guys for hanging out with us here. Before we go, just a reminder, Edgefinder is 40% off for a limited time. And for those who are watching the live stream right now, we're going to do 45% off if you message in right now to our support line. We'll drop the link to where you can speak directly to our support team if you have questions about the tool or would like to just get information about the sale. Again, like I said, that's ending soon. It's our biggest discount that we do all year long. Thank you guys for hanging out with us, and we'll see you back in the next live stream. See you guys.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. All month long, you can get the Edgefinder 40% off, our best discount of the year. Check out the links in the description below to visit the Edgefinder homepage or speak with a team member directly to get the 40% off discount now. Trade safely, and we'll see you tomorrow.